We'll take question number 5 from business valuation topic. Write down this question as very important. Very important. Question number 5. Keep the question paper in front of you and you can understand better. This question was asked in May 2020 RTP, November 21 MTP for 10 marks. And I have found this question is getting repeated at different places. So read the question. ABC Limited is considering a new sales strategy. This is a question on new strategy. What will be the benefit of new strategy on the valuation? Question is, what will be the benefit of the new strategy on valuation? Considering a new sales strategy that will be valid for the next 4 years. They want to know the value of the new strategy. This is the question. Read line by line slowly, you will understand what they are asking. They are trying to ask you to find out what will be the value of the new strategy. Following information relating to the year has just ended is available. So this is the last year data which has just ended. Income statement first. Sales, gross margin 20%, amount 4,000. Administration, selling and distribution expense 10%, 2,000. PBT 2,000. Tax 30%, 600. Profit after tax 1,400. So this portion is P&L account. And then balance sheet information. Fixed asset is 8,000, current asset is 4,000, and equity is 12,000. Now the question starts really, if the company adopts the new strategy, sales will grow at the rate of 20% per year for 3 years. Sales will grow at the rate of 20% per year for 3 years. So if sales will grow, profit will also grow. The gross margin ratio means 20%. This is gross margin ratio. Asset turnover ratio, whatever asset turnover ratio is there, will be maintained. The capital structure and the income tax rate will remain unchanged. So GP ratio, asset turnover ratio, income tax rate, capital structure will remain unchanged. Depreciation would be at 10% of the net asset at the beginning of the year. The company's target rate of return is 15%. This is the discount rate. This is the discount rate. Determine the incremental value. Determine the incremental value due to adoption of the strategy. So what is the value right now and what will be the value after adoption of the new strategy? Is it right?
Yes, sir.
Right now you will take this as a PAT and this is your cost of capital. So the current valuation of the company will be PAT upon 15% or no PAT upon 15%. So this is a question called special case of FCFF approach. So first what I'll do, like I did previously also, I'll give you a note. I'll give you a note how to solve such question of new strategy. Is it right? So are you interested in writing the note? Half page note. Say yes.
Yes, sir.
Write down. Special case of FCFF approach. 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 Then write down bracket Alcar model. Alcar model. Under that write down a no growth firm. A no growth firm is evaluating. A no growth firm is evaluating a new growth strategy. So this firm was no growth firm, and now it is evaluating a new growth strategy. We are required to calculate the value of strategy. So this is a typical question of strategy. A no growth firm will be adopting a new strategy, and the student is asked to find out the value of the strategy. Value of the strategy is equal to post strategy value minus pre strategy value. Post strategy value minus pre strategy value. Post strategy value means value of the firm after adopting the strategy, and this is what was the value before adopting the strategy. So if the value of the strategy is positive, you will adopt the new strategy. Now write down pre-strategy value. Pre-strategy value is equal to when there is no growth. When there is no growth, the value is NOPAT upon K. 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 Is it right? The value is NOPAT upon K. Then the student can ask why we have not taken FCFF. Why we have not taken FCFF? This can be your question, because the valuation is done on the basis of FCFF approach. But why we have not taken FCFF? The reason is there is no growth. So if there is no growth, write down here, net investment is zero. Net investment is zero. So FCFF is equal to NOPAT minus net investment. NOPAT minus net investment. And if net investment is zero, FCFF will be equal to NOPAT. FCFF will be equal to NOPAT. That is the logic. If you want to write FCFF also here, you can write, but then that will be equal to NOPAT in case of zero growth. Yes. Understood? Yes, so in case if you have written, can we move ahead now? Write down step 2, post strategy value. I'm just dictating the note first. We'll do the calculation after some time. Post strategy value is equal to, before that we'll write a note. There are two statements made in the Alcar model. There are two statements made in the Alcar model. Statement number 1. So what this model assumes, first is the firm's operating margin, that is EBIT, as a percentage of sale will remain constant. EBIT as a percentage of sale will remain constant. EBIT as a percentage of sale will remain constant. EBIT as a percentage of sale will remain constant. It means EBIT as well as NOPAT. It means EBIT as well as NOPAT will grow at the same rate of sale. EBIT as well as NOPAT will grow at the same rate of sale. Understood? In the problem, sale will grow at the rate of 20%. NOPAT will also grow at the rate of 20%. And statement number 2, write down. Statement number 2. Statement number 2, all turnover ratios will remain constant. All turnover ratios will remain constant. All turnover ratios will remain constant. So what is the meaning of this line? All turnover ratio will remain constant. It means your sales upon asset ratio will remain constant. Sales upon capital employed, this ratio will remain constant. Now, when will this ratio be constant? The sale is growing. If asset is also growing at the same rate, then the ratio will be constant, which means the assets or the capital employed will also grow at the same rate. Next line. This means that capital employed in bracket fixed asset plus current asset minus current liabilities will grow at the same rate as sale. Will grow at the same rate as sale. Will grow at the same rate as sale. So the further interpretation is, hence we define net investment as change in capital employed. Hence we define net investment as change in capital employed. Net investment figure you have studied in your chapter. Net investment means additional capital expenditure minus depreciation plus additional working capital. That is called net investment. So in case of Alcar model, net investment means change in capital employed, and capital employed will change at the same rate as that of change in sale. So if sale is growing at 20%, capital employed will also grow at the rate of, 20%, which means it has taken care of capex, depreciation, and additional working capital. Now I'm going to come to the question. So in the exam, your answer will start from here. Few lines I have dictated for conceptual understanding. I hope you would like it. Otherwise, you can start in the exam directly from here. Step number 1, NOPAT. Pre-strategy value. Pre-strategy value is equal to NOPAT plus K. Why NOPAT? Why not FC, FF? Both are equal. Because there is no growth. So we can take NOPAT. If you look at your question book, NOPAT means profit after tax only, because there is no other calculation involved. So 1400, can you see 1400?
Yes, sir.
Divide by 15%. Come on, be ready with the answer. So one student, Rishabh, has replied 9,333.33 lakhs. Very good. I am happy. Now write down step 2 at the top, post strategy value. This I am going to divide into 2 parts. First 3 year there will be growth. And from the 4th year it will become constant. Okay. So write down stage 1. When there are growth given for 3, 4, 5 years, you will have to prepare a table and find out the individual year FCFF. Okay. So write down the heading stage 1. Stage 1 means explicit period of 3 years. When individual year cash flow we can compute. Write down this table, serial number, particulars, year 1, year 2, year 3, year 1, 2, 3 you have written. First point A, write down NOPAT. First you write down NOPAT. They are saying that the growth will be 20%. If sale will grow at the rate of 20%, NOPAT will also grow at the rate of 20%. So what you do to ensure you don't make a mistake in the exam, write the calculation 1.20 into previous year. 1.20 into previous year. Previous year was 1400 into 1.20, 20% growth. 1680 plus 20% check 2016 plus 20% check 2419.20. Is it right?
Yes.
Now write down capital employed. Capital employed will also grow at the rate of 20%. What was the capital employed in the previous year? Look at your equity, 12,000. A balance sheet, look at balance sheet information.
Yes, sir.
Or you can look at the fixed asset plus current asset, 8 plus 4, 12,000. That will also grow at the rate of 20%. So take 12,000 plus 20%. 14,400 plus 20%. 17,280 plus 20%. 20,736. Right? I have to find out what will be change in the capital employed. So write down point number C. So the point of mistake is the student may not consider change. They may directly take the capital employed. You have to take change in capital employed. How much additional funds will be required? Okay. How much additional funds will be required to support the growth? So point number C, I will write increase in capital employed. Increase in capital employed.
That is the 20% only that will
be 20% only. You can write directly also. So 20% of 12,000 you can write. Okay. Or current year requirement is 14,400. You already have 12,000 invested.
Yes, sir.
So you need additional fund of 2,400. Now this takes care of three things. This takes care of capex, depreciation, and additional working capital. This takes care of three things. So I don't have to write depreciation again because it is already taken care of in the increase in capital employed. Next year you will require 2880. Next year 3456. Just keep taking the difference between these two numbers. Right. Now you will write FCFF. FCFF. A minus C. Students in the exam they write A minus B, but we have to take A minus C. Okay. So 1680 is your NOPAT. Additional capital required 2400. So first year there is a negative 720. Second year 2016 NOPAT minus additional funds required. So free cash flow 864 negative. Third year NOPAT minus additional funds 1036.8 negative. So what you will do next now, you will convert into present value. Point number E, present value. Take on your calculator. 720 divided by 1.15. 720 divided by 1.15. 626.09. Memory plus. 864 divided by 1.15 2 times equal to memory plus 653.31. Again 1036.8 divided by 1.15 3 times equal to memory plus
681.71.
Yes, if you have used memory plus memory recall function, you will press. You will get the FCFF for first 3 years.
1961.11.
How much you are getting? 1961.11 lakhs.
Yes, sir.
This is for first 3 year. Game is not over. From 4th year till infinite period. From
4th year till
you will get free cash flow which will be constant. And what will be that free cash flow on the screen? It will be equal to NOPAT. If there is no growth, FCFF is equal to NOPAT. So write down below note. Write down below note. Everybody please participate. Note, write down after 3 years. After 3 years, the growth rate is 0%. The student, after some months, they will ask me why we have taken FCFF as NOPAT. Because there is no growth. As there is no growth, net investment would be 0. As there is no growth, net investment would be 0. As there is no growth, net investment would be 0. Hence, FCF is equal to free cash flow is equal to NOPAT. Free cash flow is equal to NOPAT. Free cash flow is equal to NOPAT. So now write down terminal value. TV means terminal value. Terminal value means value at the end of explicit forecast period. Value at the end of 3 years. PV3. PV3 is equal to NOPAT by K. PV3 is equal to NOPAT by K. NOPAT of the 3rd year. Previous table. 2419.2. 15% is your cost of capital or target return. Now I want the students who are learning at home also, they must give me the answer. Why you have gone into silent mode? So what is the terminal value?
16128.
One student has replied 16128. Wonderful. 16128. Now this is the value at the end of 3rd year. Do I need to further discount it by 3-year factor? Yes.
Yes, sir.
So write down below present value of terminal value. Priyanka is right, Mehul is right, Rishabh is right.
So because that is PV3. No, so
That is PV3. So we have to make it PV0.
Yes, sir.
We have to make it PV0. So right now you are here, 16128. You have to come to 0. So you have to discount it by 3-year factor.
15%.
So write down 16128 into PV factor for 15% and 3 year. So on your calculator, take the factor 1 divided by 1.15 equal to. You'll get this factor multiplied by 16128. So Cabra has replied 10,604.42. Amazing. Amazing. Garg has also replied same. Sidana also same. So this is my stage 1 plus stage 2 will give me the final answer of post strategy value. Student will write, therefore post strategy value equal to, therefore post strategy value equal to stage 1 plus stage 2. Stage 1 is 3-year period and stage 2 is that infinite period. Who will give me the final total? Come on, answer. Come on, answer. Stage 1 was a negative figure, 1961.11. Stage 2 was a positive figure. So the answer is 8643.31.
Yes,
Priyanka is right. Now compare pre strategy value with post strategy value and check whether your value will increase or not. So student will reply whether it is better to adopt the new strategy or not. Come on. Whether it is better to adopt the new strategy or not.
No, it's negative 933.
So write down step number 4.
It is negative.
Value of strategy. It can be negative, it can be positive. Value of strategy equal to post strategy value minus pre-strategy value. So one student, Priyanka, said no, we should not undertake the new strategy. Rishabh also says no. The answer is right because there is some negative impact of the strategy on the value. Almost 690 lakh rupees value will go down. So 8643.31 minus 9333.33. 690 lakh you can write. Approximately 690 lakh. Write down approximately 690 lakh. Don't worry, institute will not deduct marks for rounding off. Since the strategy is negative, since the value of strategy is negative, write down the comment and complete the answer. Since the value of the strategy is negative, since the value of the strategy is negative, the strategy should not be implemented. The strategy should not be implemented.
All this also depends on the company's target rate of return. That changes
A
everything.
lot depends on discount rate. Discount rate is very important because that can affect your answer. Yes, you're right. But we are a student, so whatever discount rate is offered to us, we will use that. Okay. Some student can ask, what about the depreciation at 10%? That is already included in the change in the capital employed. The effect of that depreciation has already gone into the change in the capital employed. So don't worry about that. Now we'll go to next topic, mergers and acquisition. Next topic, merger and acquisition, highly important topic, and there can be a large number of questions on this topic. Okay, there can be a large number of questions on this topic. So we have found out 4 important questions. Due to fast track revision batch, we'll take some important questions. There is huge variety of sums we can solve here. Okay, but let us take some of the typical exam questions which they are likely to ask. Question number 1. Come to question number 1. This question number 1 is from October 2021, MPP for 8 marks. Mark it important. All 4 questions I am going to take will be treated as important. Intel Limited, promoted by a transnational company, is listed on the stock exchange holding 80%. So Intel Limited is promoted by this company, transnational company, and it is holding 80% in that company. 20% is with the public. 20% is with public. 20% is with public. This is public holding is called non-promoter holding. Public holding is called non-promoter holding. Is it right? This is a very good question in the current scenario. If in India there is a public limited company, listed company. Public holding should be at least 25%, at least 25%. But here the public holding is less than 25%. So this company will have to issue more share to the public. Okay. The value of the floating stock is rupees 45 crore. What is the value of floating stock? Value of 20% stock. The value of 20% stock which is available with the general public is 45 crore. So you can find out the total value of the company from this information. 45 divided by 20%.
225.
So 225 will be the total value of the company. The current market price is 150 rupees. Capitalization rate is 20%. The promoter holding is restricted to 75% norm, 75% as per the norms of listing requirement. So promoter holding is right now 80. They will have to bring it down to 75%. Is it right?
Yes, sir.
This in recent past, some of the Adani group company had a similar situation where the public holding was less than 25%, and therefore now they are trying to increase the public holding to 25%. So therefore in the current scenario this question is very appropriate. Now they are saying the board of directors have decided to fall in line to restrict the promoters holding to 75% by issuing bonus share to minority shareholder. Who are these minority shareholder? This public.
Okay.
Public is minority shareholder. They are holding 20% only. The promoter is holding 80%. So they will have to issue bonus share to the public. So public shareholding will increase. If public shareholding will increase, automatically the promoter's holding will reduce
It will come down.
while maintaining the same P ratio, while maintaining the same price earning ratio. So price earning ratio will remain the same before bonus issue also and after bonus issue also. You are required to calculate the bonus ratio. So what should be the bonus ratio such that hello, what should be the bonus ratio such that
The P ratio also remains the same.
P ratio also remains the same. And second question is what will be the market price after the issue of bonus share? And third question is what will be the free float market capitalization? Free float market capitalization means non-promoter value of the shares held by public or non-promoter or minority interest after the bonus share. Is it right? First you will try. I will give you 1 minute to try your luck and tell me what should be that bonus ratio which will reduce the public holding to 25%, which will make public holding 25%. Yes, anybody wants to reply? Some students have already replied. Yes. Let me check who has got it right. Now, what is the free float valuation? 45 crore.
Yes, sir.
This is 45 crore. And what is the market price per share? 150. So can you calculate the number of shares held by minority? 45 crore divided by 150 will give you number of shares held by minority. So how much will that be? 30 lakh. Minorities are holding 20% share in the company. So the total number of share of the company is 1 crore 50 lakh. Total number of share of the company is 1 crore 50 lakh. Out of that, 80% is held by promoter. So promoter holding is 1 crore 20 lakh.
Yes, sir.
Now they want promoter holding should be 75%. Now they want promoter holding should be
75%.
So the total number of share of the company should be 1 crore 20 lakh divided by 75%. If the total share of the company is 1 crore 60 lakh, promoter are holding 1 crore 20 lakh, promoter share will be 75%. Right? Public holding should be how much? 40 lakh. Why 40 lakh? Out of 160, 120 is held by promoter. So if out of 160, 120 is held by promoter, public should be holding 40 lakh. 40 lakh. And how much they're holding right now? 30 lakh. So we have to increase the public holding from 30 to 40. So number of bonus share to be issued must be 10 lakh. 10 lakh bonus share against 30 lakh existing share. 10 lakh bonus share against existing 30 lakh share. If you give, the public holding will become 40 lakh. The bonus ratio will be 1:3. The answer is 1:3. Rishabh has given this answer. Very good. Amazing. So now we'll write down the answer of the first part. So write down the answer of the first part. Calculation of number of shares, bonus share to be issued. Calculation of number of bonus shares to be issued. Calculation of number of bonus shares to be issued. Please write down calculation of number of bonus share to be issued. Then you write down in detail. First point A, free float market capitalization in rupees crore. See the presentation. You have to write in detail. All calculation must be shown. Format can be different, but presentation should be such that all calculation must be there. So we have 45 crore rupees. Free float market capitalization means shares held by minority interest, shares held by non-promoter. Current market price is 150. Please write down little fast. Current market price is 150. Number of shares held by minority. Number of share held by minority in crores. 45 crore divided by 150. Just remove this crore, because we are writing actual absolute digits. We are writing 30 lakh shares are held by minority. Now, minority shareholding percentage at present is how much? 20% today, before the bonus. Before bonus, minority holding is 20%. So if minorities are holding 30 lakh and their stake is 20%, can you calculate the total number of shares? So write down total number of shares at present. C divided by D. C divided by D. This company right now is holding or has issued 1 crore 50 lakh shares. This company has issued 1 crore 50 lakh shares. Up to this, if you have understood, then you can understand the remaining answer. Is it right? Point number F, write down. Shares held by promoters 80% of 1 crore 50 lakh. 80% of 1 crore 50 lakh. 80% of 1 crore 50 lakh. Revised shareholding percentage of promoters. Revised shareholding percentage of promoters after bonus issue. Revised shareholding percentage of promoters after bonus issue. So how much do we want? We want 75%.
Yes, sir.
We want 75%. Promoter will not be issued bonus share. Promoter will continue to hold 1 crore 20 lakh and divide by 75%. Divide by 75%. So now it will be 1 crore 60 lakh. 1 crore 60 lakh. 1 crore 60 lakh. If promoter is holding 1 crore 20 lakh, desired shares 1 crore 60 lakh. So public holding should be 40 lakh. Shares of minority after bonus. H minus F. H minus F. 40 lakh. How many shares minorities are holding right now? 30 lakh. How much do you want after bonus issue? 40 lakh. So therefore, bonus shares issued to minority, bonus share issued to minority, bonus share issued to minority will be I minus C, 10 lakh. I minus C 10 lakh. 10 lakh bonus share against 30 lakh existing share. So point number K, bonus ratio. Bonus ratio is 10 lakh is to 30 lakh. 10 lakh is to 30 lakh. That is 1 is to 3. Was it difficult or easy?
Easy.
It was easy, but you have to practice because the steps should be done properly. Now tell me any query on first part. Next question is, which again you will try, what will be MPS after issue of bonus share? I am giving you a chance to reply 30 seconds. What will be market price per share after bonus share? 30 seconds allowed to you. Please reply. Anybody wants to reply? Market price per share after bonus issue. Let us say this question appears in your exam. How will you solve? Market price is equal to EPS into P ratio. So you have to find out both the numbers. What will be EPS after bonus issue and what will be P ratio. So the student will have to find out these two numbers to answer this question. Anybody wants to reply? I am waiting for your answer. I am waiting for your answer if you want to reply. Okay. So now write down, I will tell you, there is a hint in the problem. Hint is that capitalization rate is 20%. You have studied in your financial management, capitalization rate means EPS upon MPS. EPS upon MPS. And P ratio means MPS upon EPS. Capitalization rate is EPS upon MPS. Therefore, P ratio is MPS upon EPS. So can I say P ratio is equal to reciprocal of capitalization rate. Oh my God. P ratio is reciprocal of capitalization rate. That is a concept one should know. So once you know the P ratio, you can solve the problem easily now. So write down P ratio is equal to 1 by 20%. If nothing is given, then take P ratio as reciprocal of capitalization rate. Capitalization rate is EPS upon MPS. So that was the trick in this question. P ratio will be 1 by 20%, that is 5. And what is the current market price? Current market price 150. Current market price 150. So if you know market price, if you know P ratio, can you tell me what is EPS? EPS will be market price upon P ratio. Market price upon P ratio. C divided by B. EPS is 30 rupees. EPS is 30 rupees. If EPS is 30 rupees and the total number of shares before bonus issue is 1 crore 50 lakh. Total number of share before bonus issue is 1 crore 50 lakh. Now this all requires some mathematical skill, okay? Some basic understanding of the numbers. EPS is 30 rupees. Number of shares are 1 crore 50 lakh. Can we not calculate the total earning of this company? So what will be the total earning of the company? Total earning of the company will be 30 rupees into 1 crore 50 lakh share. That will give me total earning D into E. Will the bonus share affect the earning? Tell me, yes or no. Everybody, students at home also. Will the bonus share issue affect the total earning? Will the bonus share affect the total earning? The answer is no. Because in bonus share, we don't get additional capital, additional funding. So my business is run with the same capital.
Yes.
Write down total number of shares after bonus issue, which is 1 crore 60 lakh as per step 1. Total number of share after bonus issue 1 crore 60 lakh. 1 crore 60 lakh. Now write down revised EPS. Revised EPS after bonus issue. It will be F by G. Revised EPS after bonus issue, F by G. 28.125. 28.125. Then write down P ratio. The question says P ratio will remain same. Somewhere in the problem they have mentioned P ratio will remain same. So same means it will remain 5. Now tell me what will be MPS after bonus issue? What will be MPS after bonus issue? Is it 140.625? EPS into P ratio, G into H.
140.625.
Very good. 140.625 is right. 140.625 is right. Come on, everybody. Very good question. Okay. Nobody was able to answer this number either in the class or at home. Third question is, what is free float market capitalization after bonus? Free float market capitalization after bonus. Any other method also is right if you are able to reach the same number. Okay, don't worry. Because it's a mathematical topic, so you'll get the same result. Total market capitalization divided by total number of share. Even that will lead you to the same result. But this method of presentation is okay because the P ratio you have to present in your answer. Write down next answer. The free float market capitalization after bonus issue. The free float market capitalization after bonus issue. Both methods are right. You can either take market capitalization divided by number of share, or you can multiply P ratio into EPS. Free float market capitalization. Free float market capitalization means market value of shares held by non-promoter. Market value of shares held by non-promoter. So you will first write number of shares held by non-promoter.
40 lakh.
40 lakh. Market price after bonus issue. Market price
140.
after bonus issue.
165.
140.625. Last line. Therefore, free float market capitalization. Therefore, free float market capitalization is 56.25. 56.25. This is the answer, 56.25. In crores. In crores. So non-promoters will benefit because of this exercise. Their valuation was 45 crore. Now they have gone to 56.25 crores. Next, write down question number 2. Another very good question from July 21 exam for 5 marks. And you probably may not have done it before. Okay. Again, like this question number 1, it requires a lot of calculations. Are you ready? SM Limited has a market capitalization of 3,000 crore. Total market value of all share is 3,000 crore. And the current EPS is 200 rupees. EPS and P ratio is 15. So my question is, what is current MPS? 300 rupees. 200 into 15 is how much? 3,000.
3,000.
This is the total market cap, means total value of all the shares. Each share is 3,000 rupees. So what will be the number of shares? Can you guess number of share? 3,000 is the market cap, 3,000 is the market price per share. So the number of shares will be 1 crore. So indirectly one figure is given, number of share is 1 crore. The board of directors is considering a proposal to buy back. Oh, this is reverse. Buy back. Previous question was issue a bonus share. Many companies in the recent past has gone for buyback. Okay, like TCS has gone for buyback. Paytm has gone for buyback. So practically also you have to check, do we see such thing around us? The answer is yes. So company is considering a proposal to buy back 20% of share. 20% means they are going to buy back 20 lakh shares. Do you agree? When you are reading the problem, mind should also keep working. The company is planning to buy back 20 lakh shares at a premium. Now this is what you will have to compute sometime later. At a premium which can be supported by the financials of the company. The board expects post buyback market price of 3057. So they want that after the buyback is complete, the MPS should be 3057. Post buyback P ratio, price earning ratio, will remain same. So 3057 is the market price. P ratio will remain 15. So what will be the EPS after buyback? What will be EPS after buyback? 3057 divided by 15. 203.8. So this will be your EPS after the buyback. Okay. And how many shares you are left with after buyback? 80 lakh shares. 100 minus 20. 20%. So what will be your total earning after buyback? What will be your total earning after buyback? EPS is 203.8. Number of shares are 80 lakh. So what will be total earning after buyback? Total PAT after buyback. PAT. Multiply. Take your calculator. 80 lakh shares into 203.80. So your post buyback capital, post buyback profit is 16 something.
163.04 crores.
16. You give me in 5 digits. Multiply 80 into 203.8. 16304. Mehul is right. So this will be my PAT after buyback. Okay. Let us read the problem. The company proposes to fund the buyback by availing 8% bank loan. So the amount you are going to pay for the buyback will be borrowed from bank at 8% interest. Tax rate is 30%. Calculate the interest amount which can be paid for availing the bank loan. The interest amount which can be paid for availing the bank loan. Very interesting question. Second question, what is the loan amount to be raised? Loan amount will be interest divided by 8%. Second question is easy if you can answer the first question. If first is wrong, second is automatically wrong. You will not have to take extra effort to make it wrong. Okay. And the third question is, what is premium per share and the percentage premium paid over the current market price? So for that you will have to find out what was the buyback price. Buyback price will be compared with current price 3000. The difference is called premium. And the premium divided by 3000 will give you the premium in percentage. Compared to current price, how much premium the company has given to the shareholder to induce him to go for buyback. So since you are an intelligent student, I'm going to ask you first answer. Without any further discussion, take 30 seconds mental rest and try to reach interest amount. 30 seconds starts now. Assume that I am taking your class test today. Give me the interest amount.
In this question, the total earnings will also change because last question it was a bonus issue. No? So
yeah, total earning will definitely change because
fund flow is going up.
You have taken a loan. So because of the interest paid, your earnings will change. Is it right?
So also because of interest paid and also we are paying back. No?
Yeah, you do your calculation. What you are saying is right. Based on your understanding, give me the interest figure. Whatever data they have given, based on that you will answer. Theoretically, earnings will change because of reduction in the capital employed. But that capital reduction they have supported by bank loan. not from existing capital.
Okay. Then the 8% change that will.
Whatever is the amount paid to shareholder is replaced by a bank loan.
Bank loan. So 8% that will be.
Right. But give me the answer first. My question is interest amount. Student has a query, add answer. What is the interest amount? My question is, what is the interest amount? Very easy question. Yes, please reply. Nobody has replied till now. I am still waiting. So see, the answer is very easy. What is your current profit after tax? EPS is 200 multiplied by 1 crore shares. So your current earning in rupees in lakhs is 20,000 lakhs, and your earning after tax after buyback was 16,304. This difference represents interest, because only because of interest your earning will change. Earlier your earning after tax was 2,000. This 200 into 1 crore share. Since we are writing in lakhs, it will become this much.
Okay.
Now this is your earning after tax. The difference will be 3696. Sorry, 3696.
3696.
This is the interest after tax.
That is the interest amount.
Interest after tax amount, because it is, we are comparing earning after tax. So interest before tax will be 3696 divided by 1 minus 0.3. So the interest before tax will be 3696 divided by 1 minus 0.3. So that is 5280. 5280 lakhs would be your
interest before tax. Yes,
before tax. And this you divide by 8%. This you divide by 8%, you'll get the loan amount also.
66,000.
66,000 lakhs or 660 crore. Rishabh has already replied. Very good. Congratulations. You are right. You are on the right path if you can solve questions like this. So now I'm going to present my answer, which will cover first and second part. Is it right? And then once you get this figure right, you can answer the third part also. So write down first part.
A good question.
Good question. You're right. Good question. I will take only good question for you, which will give you a lot of understanding. Calculation of number of shares to be bought back. Calculation of number of shares to be bought back. Calculation of number of shares to be bought back. That was an easy part. First write down point A. EPS before buyback. EPS before buyback. EPS before buyback. 200 rupees. Write down in rupees. Then write down P ratio 15 times. P ratio 15 times. MPS before buyback in rupees. MPS before buyback in rupees A into B 3000. Okay, this I think everybody should get it right. At least 0.5 marks you will get if you write so much. Then you write down market capitalization before buyback in rupees in crore. Market capitalization before buyback rupees in crore 3000, which is given. Therefore, number of shares before buyback D by C 1 crore. Number of share before buyback 1 crore. 3000 divided by 3000. 3000 divided by 3000. Correct. And then write down number of shares to be bought back is 20% of 1 crore. 20% of 1 crore. 20 lakh shares. So after the buyback, the number of shares will become 1 crore minus 20 lakh, 80 lakh. Is it right?
Yes, sir.
After the buyback, number of shares will become 80 lakh. Now my next two questions will be answered in this table. Step 2, calculation of interest, which can be paid for availing bank loan, and the loan amount raised. So I am answering our two questions. If you will get this much right, you will get 4 marks. And if you get the last one also right, you will get full 5 marks. A very interesting question. First, write down desired post buyback price per share. Desired post buyback price per share. Desired post buyback price per share 3057. Then write down P ratio. P ratio is 15 times. P ratio will not change. So if your price is 3057 and if your P ratio is 15, can you calculate the post buyback EPS? The post buyback EPS will be A by B, right? A by B 203.80. Then you write down point number D, number of shares after buyback.
Yes, sir.
Number of share after buyback, we had 1 crore share and we have bought back 20 lakh. So the number of share after buyback would be, write down 80 lakhs. Number of share after buyback would be 80 lakhs. Number of share after buyback would be 80 lakh. Point number E, post buyback EAT. Post buyback earning after tax. This is my EPS and this is number of share. So when you multiply these two, you'll get the total earning after tax after buyback. Multiply C into D, rupees in lakhs, 16304. 16304. And what was pre-buyback EAT? Pre-buyback EAT was, you had 1 crore share, that is 100 lakh shares, and the EPS was 200 rupees. So the
Yes.
pre-buyback earning after tax was 20,000. But it has gone down from 20,000 to 16,304. The reason for this drop is the interest paid on the loan. There is no other reason. After tax, because we are comparing earning after tax figure. So the difference will also be earning after tax figure. Difference will also be post tax figure. So now point number G, write down. Point number G, write down post-tax interest that can be paid. Post-tax interest that can be paid, that is G minus E. This is not G minus E, it should be F minus E.
3696.
Yes, F minus E.
So if tax rate was not given, we would have assumed this only as.
Yes, if tax was not there, then this is the
tax.
interest. Okay, if tax is not there, then this is the interest. But tax is there. That is where the institute will earn income from you. Because many students will take this only as an interest. This is not interest, this is post-tax interest.
Post-tax interest.
So the pre-tax interest will be 3696 divided by 1 minus 0.30, that is tax rate. So this is the actual interest you are going to pay, 5280.
Yes, sir.
And the interest rate is 8%. So one more answer you will get here is the loan amount raised. Loan amount raised. The loan amount raised will be 5280 divided by 8%.
66,000.
66,000 rupees
In lakhs.
in lakhs. Write down rupees in lakhs. Rupees in lakhs, write down. Or if you're writing in crores, 660 crore. This is the amount they have used for buyback. 66,000 crore or lakhs they have used for buyback 20 lakh shares. Correct?
Yes, sir.
So can you find out if you are paying 66,000 lakhs for buying back 20 lakh share, what is the buyback price you have paid to your investor? How much per share you have paid? 66,000 lakhs divided by 20 lakh. Per share paid to buy back the share is how much? Calculate. Per share amount paid. Yes, come on student, why are you not replying? So the per share amount you paid to buy back is 3,300. And the current market price is 3,000. So instead of 3,000, you are paying 3,300.
So
10% is the buyback premium. You are right.
10%.
Yes, very good, Rishabh. So write down the last answer. This is bonus mark. If you get that 66,000 figure right, this answer is automatic. Write down step number 3. Calculation of buyback premium and buyback premium percentage. Calculation of buyback premium and buyback premium percentage. First you write down amount paid for buyback, same figure, 66,000 lakh. The loan raised was fully utilized for buyback purpose, 66,000. Point B, number of shares bought back, in bracket step 1 is 20 lakh. Both figures are in lakhs. You can divide directly. Point C, buyback price per share in rupees. Buyback price per share rupees 3,300. Current market price per share 3,000. Current MPS 3,000. So first answer, what is buyback premium paid? Buyback premium paid is C minus D, 300 rupees. And then what is the buyback premium percentage they are paying? So write down percentage premium. Just write down percentage premium and you will take 300 divided by 3,000. That is 10%.
Lovely sounds.
Good sum. Enjoyed.
Yes, sir.
And how much you'll get? Only 5 marks. This is our professional exam. In BCom, they asked it for 20 marks. And in professional exam only 5 marks. What an injustice to us.
But this was a good sum, sir.
Now you have to practice. Question number 3, another good sum, which is a 20-mark question. But it is very lengthy also, and it deserves 20 marks. This is normally taught in the regular SFM batches, but because it covers many concepts of the chapter in one problem, I decided to take question number 3. Are you ready?
Yes, sir.
Yes. Everybody should say, then I will take. All the students who are learning from home will say yes, then I will start. Okay, so everybody is saying yes. Question number 3, write down, very important. The following information relating to the acquiring company Abhiman Limited. Abhiman is the acquirer, underline. And the target company is Abhishek Limited. Acquiring is Abhiman. Target is Abhishek. Are available. Both the companies are promoted by a multinational company, Trident Limited. So who is the promoter? Promoter is Trident. The promoter is holding 50% and 60% respectively in Abhiman and Abhishek Limited. So these two companies are actually subsidiaries of Trident Limited. Are actually subsidiaries of Trident Limited, because Trident is holding 50% in Abhiman and 60% in Abhishek. So what is free float percentage in these two companies? This is 50. So in Abhiman, the free float is also 50%. And in Abhishek, the promoter is holding 60. So the free float will be 40% here. Understood? Now it says share capital in rupees 200 lakh, 100 lakh, reserve and surplus in rupees 800 lakh, 500 lakh. If you add these two, what do you call it? If you add share capital plus reserve, what will you call it?
Equity.
You will call it shareholder fund or net worth. So we will call it net worth or shareholder fund, right? Then the paid up value per share is given 100, and here it is 10. Be careful, they are different, 100 and 10. Now just quickly answer. Share capital is 200 lakh, paid up value per share is 100. So indirectly, how many shares are there in Abhiman Limited? 2 lakh.
Yes, sir.
And in Abhishek Limited, 100 lakh.
100 lakh.
Divide by 10. How many shares are there in Abhishek Limited? 100 divided by 10.
10 lakh, sir.
100 divided by 10, 10 lakh shares. Some hidden information are involved. Then free float market capitalization is 400 and 128. We have already discussed.
50% and 40%.
Here free float is 50% and here free float is 40%. Then P ratio is given 10 times, 4 times. So these are basic data required for solving such questions. Okay. Now they have written a long paragraph. Trident Limited is interested to do justice to the shareholders of both the companies. For the swap ratio, weights are assigned to different parameters by the board of directors as follows. Now, how do you calculate the swap ratio? The swap ratio will be based on 3 parameters. Book value per share, earning per share, and market price per share. So not one parameter, but 3 parameters will be used. Book value, earning per share, and market price. Which means I have to calculate first these three ratios or numbers for all the three companies. Is it right? Then compute the swap ratio based on this. Give them this weightage, and then you will get the swap ratio. So this itself will be a long task to find the swap ratio. For that, I need the book value per share of both the companies, EPS of both the companies, market price per share of both the companies. This is usually taught in our regular class, how to compute swap ratio when more than one parameters are used. Okay. Now your real intelligence will start from here. B. What is the book value, EPS, and expected market price of Abhiman after acquisition of Abhishek? So you have to compute post-merger book value, post-merger EPS, post-merger market price. And to help you, they have said assume P ratio will remain unchanged and all the assets and liabilities of Abhishek will be taken over at book value. So no problem. You just have to simply add the net worth of the two companies, that will give you total book value. Okay. Any query on this? No query. Very easy question, but it's a lengthy question and requires patience. Third question is calculate. Under that, again, three questions. What will be promoters' revised holding in Abhiman? What will be free float market capitalization? Not only that, to make your life more miserable, also calculate the number of share, EPS, and book value per share if after acquisition of Abhishek, Abhiman Limited decided to issue bonus share in the ratio of 1:2 and split the stock as rupees 5 each fully paid. So there is a bonus issue, there is a stock split also. Stock split means shares of higher denomination will be divided into shares of lower denomination. Earlier the share was 100 rupees. Now they want to reduce the face value to 5, which means 20 share will be issued against 1 share. So first they will give bonus share and then they will also go for stock split. So the number of shares will increase substantially. So first you will have to find out what will be the new share after bonus and stock split, and then you will have to calculate again the EPS and book value per share. So did you like this question? First tell me yes or no.
Lengthy questions about good.
But did you like it or
Yes,
not?
sir, yes.
Like, okay. So
Thank
write
you.
down. First we will find out for the two companies their individual BVPS, EPS and MPS before the merger. Is it right? Start. Question is lengthy but very easy. Today as a homework you will revise all the questions that we have done till now. Okay. So write down, students, calculation of book value per share, earning per share and market price per share. Right hand side two columns. Abhiman and Abhishek Limited. So how do you calculate book value per share? You have to calculate share capital plus reserve and divide by number of shares. Is it right? Write down share capital. Question should be in front of you. Share capital rupees in lakhs, 200, 100. Paid up value per share, 100, 10. Paid up value means per share value. Number of shares, point number C, A by B. Number of share in lakhs, A by B.
2 lakhs, sir.
In lakhs, 2 and 10. 2 and 10. Very good. Come on, next. Reserve and surplus. Reserve and surplus in rupees in lakh. Rupees in lakhs. 800. 500. So this is your share capital.
Yes, sir.
This is reserve and surplus. So if you add them, you'll get the net worth. That net worth divided by number of shares will give you book value per share. Okay. So point number E, write down net worth. A plus D. Net worth, write down A plus D. You add share capital and reserve. You will get 1000 here. Again 100 plus 500. You'll get 600 here. Now write down promoters holding percentage. In the question, they have given you promoters holding percentage in the first paragraph. Promoter holding percentage 50% and
40%.
60%. Promoter is 50,
Yes,
60.
okay, yes, sir.
Non-promoter will be 1 minus promoter. Okay. 100 minus promoter. Continue. How many points we have written? F. So please continue below this table. Please continue below this table. Write down point G, non-promoters holding. Non-promoters holding will be 50% and 40%. Agreed?
Yes, sir.
And what is the free float market capitalization?
Given.
Is given. Given in the fourth line of the table. 400 and 128. 400 and 128. Total market capitalization. Total market capitalization.
800 and 120 divided by 50%, 320.
H by G.
800 and 320.
800 and 320. Point number J. MPS, market price in rupees. Anybody who wants to reply? Market price. Total market capitalization divided by total number of shares. So I upon C. How much is the answer? 400. Very good.
32, I guess.
320 divided by 10. 32. You're right. Amazing. Now write down P ratio. P ratio in times. P ratio in times. Given. P ratio is given in the fifth line of the table. 10 and 4. P ratio is 10 and 4. So can you tell me what will I get next? MPS is known. P ratio is known. What will you get now?
Earnings per share.
EPS. Very good. EPS.
Okay. And
EPS in rupees. Tell me how much is EPS in rupees? J by K. J by K. Yes, student, come on.
and 8.
40 and
8.
8. 40 and 8.
JKLM.
Now write down total earning. What is total earning of the firm? C into L. C into L.
So 80 and 80.
Number of share into earning per share. Anybody?
80 and 80.
80 and 80. Both are 80, 80. Very good. And one more line which is pending since long. Book value per share. This I could have written earlier also. Anybody who wants to answer book value per share, E by C. Net worth by number of share. Net worth divided by number of share in rupees. In rupees, come on, in rupees write down. E by C. So are you getting 500?
Yes, sir.
And second column? 60. Very good. Second is 60. So I got book value per share, earning per share, market price per share. So first we will compute swap ratio based on this, multiply by respective weights given in the problem. That will give me swap ratio, exchange ratio, and then we can calculate number of share to be issued. Okay. So once you get these numbers right, now the remaining part of this question is just a formality. So can we go ahead? Yes. Step 2, swap ratio. Step 2, write down swap ratio. Swap ratio in this problem is weighted average swap ratio, where we are assigning weights to different parameters. Three parameters. Students will write format first. Presentation is also equally important. First column basis, second column swap ratio, third column weight, fourth column weight into swap ratio. Right? Are you with me?
Yes, sir.
First basis book value per share. And how do you calculate the swap ratio? Target company ratio divided by acquiring company. Target company is Abhishek. Acquiring is Abhiman. Book value per share of Abhishek divided by book value per share of Abhiman. What will be the ratio? 60 by 500. Is right? 60 by 500. 60 by 500. 60 by 500 is 0.12. Very good.
Yes, sir.
Now EPS, based on EPS, write down second EPS. Now what was the EPS of Abhishek? EPS 8 divided by EPS of Abhiman,
divided by
40, 0.2. Okay, you will give me MPS. You will give me MPS.
32 divided by 400. So
32 divided by 400. Is it 0.08?
Yes, sir.
0.08. Now give the weights according to question. 0.25, 0.50, 0.25.
The 0.3 first weight.
0.03, 0.10, 0.02. Check the calculation. You can't make mistake here. Your remaining entire answer will go wrong.
25, yes, yes.
So the total comes to 0.15.
So we can write the first one as 0.25 also, no?
0.25, yeah. It is actually 0.25. You can write 0.25. So the swap ratio is 0.15:1. 0.15 share will be issued against one share. 0.15 share will be issued against one share.
Okay.
0.15 share will be issued against one share. Now the remaining questions are very easy. Only some calculations are involved. Step 3, write down. Right below. Step 3. Number of shares issued. Number of shares issued. Go to the question. Abhishek Limited has got 10 lakh shares. Yes or no? 10 lakh into 0.15. 10 lakh into 0.15. 1.5 lakh share. 1.5 lakh shares. 1.5 lakh shares. Now write down step 4. Total number of shares after merger. Total number of shares after merger. Abhiman Limited has 2 lakh share. Abhiman Limited has 2 lakh share.
And it issued 1.5.
And it issued 1.5 lakh share.
1.5.
So now it will have 3.5 lakh shares. Do you agree?
Yes, sir.
If you agree, then go ahead. Any query till now? Now my next question is point number B. Keep question in front of you. What is book value, what is EPS, and what is market price after acquisition? Assume P ratio will remain same. Okay, we are answering part B. This is the answer of part B. Post merger book value per share. Right hand side rupees in lakhs. BVPS means book value per share. The problem says the assets will be recorded at their book values. Means you just have to add the net worth of the two companies. You just have to add the net worth of the two companies. So combined net worth is.
So whatever calculation we had.
We have done in the earlier table. We will use it now. Correct, because the assets will be recorded at book value. So same assets plus same asset is the total. What is net worth? Suppose this is my balance sheet. We have share capital, we have reserve, we have asset, we have liability. So asset minus liability, share capital plus reserve is asset minus liability. So this will be recorded at book value. So the total will match. Total net worth will match.
Yes.
Is it right?
Yes, sir.
So write down total net worth 1000 plus 600. So write down this comprise of 350 lakh share capital. Why 350 lakh share capital? You can see here 3.5 lakh into 100, and remaining will be reserve and surplus. Remaining amount will be reserve and surplus.
The net worth will be same, but the EPS and everything will change, no? Because
number of share will change. I'm only telling net worth will be same. I'm not saying EPS will be same. That is why we have to compute EPS again. Net worth will be same. The logic is asset plus asset will be same. Liability plus liability will be same.
Yes, sir.
So when both are same, the difference of asset minus liability will be same. Okay, so can we move ahead now? Number of equity share, here you see 3.5 lakh. Number of equity share we have computed in step 4 above, just above, 2 lines above, 3.5 lakh. 3.5 lakh. If you don't want to write this, don't write. Don't take stress. Okay.
That is what is confusing.
Unnecessary. Don't take stress. Something if it gives you stress, don't do it. Except CA course, because that also gives lot of stress. But at least some professional degree I require. I have to eat bread butter also. Yes or no?
Yes.
Otherwise, remaining thing ignore.
That was confusing.
So that is not confusing. That requires intelligence. Unfortunately, we are not in a mood to apply that. 3.5 lakh into 100 is 350 lakh share capital. Remaining is reserve. For that I have to do accounting, but that is not my scope of work right now.
3.5 lakhs is this thing, no, sir.
Number
of shares,
into
but
100 rupees face value. 350 lakh. Achha, you ignore it. Okay, let us not waste time. If you are not comfortable with this, then kindly remove. If you have understood it, keep it. Okay, choice is yours. So BVPS is 457.14. 457.14.
Yes, sir.
Correct. Now next is step number 6. Very easy. Bonus mark. Calculation of post-merger EPS and MPS. Everybody can ask question. Everybody can reply. Post-merger EPS and MPS. Nothing to explain here. Total earnings will not change. So write down total earning after merger. You have already calculated total earning in the step 1. 80 lakh for both companies. 160. Number of shares already calculated in the step number 4. Number of share in lakhs 3.50. Number of share 3.50. Post merger EPS. Very easy question, nothing to explain. A by B in rupees. $45.71. Check. P ratio remains the same 10 times. P ratio of Abhiman Limited will remain same 10 times. So therefore post merger EPS C into D without calculator 457.10. 457.10. $457.10. Is it right? 457.10.
Okay.
Any query now?
वो जो paid up value है ना, that is actually the face value ना.
Paid up value per share is face value per share.
3.5 lakhs into 100 per share.
Yes, now you got it. So this completes our second answer. Sometime in the exam they only ask part A and part B, okay? But this time they have asked you additional questions. So part C now. Now we are replying to part C. Write down part C and below that write step 7. Promoters revised holding. Promoters revised holding and free float market capitalization. So this will answer my part 1 and part 2 of part C. So how do I calculate it? Very easy. First you write down point A, total number of shares after merger. Total number of shares after merger
3.5
is 3.5 lakh.
Yes, sir.
Total number of share after merger 3.5 lakh. Point B, write down promoters holding. Promoters holding. The promoter was holding earlier. Understand this part. Earlier they are holding 50% of 2 lakh. This is your existing holding. Correct? In Abhiman Limited. This is existing holding in Abhiman Limited, 1 lakh, 50% of 2 lakh. Then in the Abhishek Limited, they are holding 60% of 10 lakh. And this is your swap ratio. So they will get 6 lakh share they are holding multiplied by swap ratio. So these are the shares got as a result of merger. 1 lakh they are already holding. 6 lakh into 0.15 will be issued to them. So my question is, what is the total number of share held by promoters after the merger?
1.9 lakh.
1.9 lakh. Very good. So can you not convert into percentage?
Yes, sir. We can.
Right. Promoter holding percentage 1.9 divided by 3.50.
54.29.
That is 54.29. So non-promoter holding percentage.
1 minus promoter.
100 minus 54.29. What is the answer?
1 second. Calculation.
Non-promoters holding percentage 45.71%. Keep trying, keep trying. This is again a very good question. What is the market price per share in the step number 6? Market price per share in the previous step 6 was 457.10. The question is, what is free float market capitalization? This is total number of share. This is non-promoter holding. This is MPS. So if you multiply these three things, don't you think you will get the free float market capitalization?
Can you repeat?
Total number of share into non-promoter holding will give you number of share of non-promoter multiplied by price per share will give you the value of shares held by non-promoter. Next point, write down total market capitalization.
3.5 minus 1.
Total market capitalization is 3.50 into 457.10, 1599. But suppose you want to write directly, you can multiply three things. You can also multiply by 45.71. So last line of this answer is, last line of part B, free float market capitalization. Free float market capitalization, total market cap into percentage of shares held by non-promoter. So the answer is 731.29 approximately.
So can we do it this way?
Any way you can do it. If your answer is same, you are most welcome.
So, but there's a little bit of difference, rounding of difference.
Rounding of difference after decimal is okay.
0.36 आता है.
0.36 is okay. One student has got 0.36, one has got 0.42 also.
3.5 minus 1.9.
See, enjoy 731 now. Why you are bothered about decimals? Who talks about decimal? Do you say that market capitalization of Reliance is 5,000 crore 0.32? Then round up only. Matter closed. Last step number 8. Now the question has added one more part. This is part C3. This company has issued bonus share also, 1:2, and it has gone into stock split ratio 20:1. Is it right? So after that, our number of share will change. If the number of share will change, book value per share will change, earning per share will change. Is it right? So first write down the heading. Student has to write properly. Sometimes the student write directly and then the institute can deduct marks. So please write down number of shares of Abhiman Limited after bonus share and stock split. Number of shares of Abhiman Limited after bonus share and stock split. I am asking you, you are looking at me. What is the answer of this? Final answer. Show your intelligence. What is the final answer? Number of share before bonus and stock split is 3.5. Bonus share is in the ratio of 1:2.
1 for every 2. 3.5.
So 1 for every 2. So number of share will increase.
1.5.
And again that will be multiplied by 20 because one share will be split into 20 share. Why 20? 100 is the present face value. The revised face value is 5. So for one share, the company will issue 20 share. In case of stock split, the company reduces face value and increases the number of shares.
Yes, 100 divided by 5.
Right.
20.
So write down the answer. One student has already replied. Very good. Let me check. First write down point A, number of shares. 3.5. Point B. Point B, bonus ratio 1:2. Point C,
1.75.
Bonus share 1.75.
Yes, sir.
So what is number of shares after bonus issue?
3.5 plus 1.75. 5.25.
5.25. Point E. Share split ratio. Share split ratio 100 by 5, 20. One share will be converted into 20 share of 5 rupees.
Yes, sir.
Then write down number of share after share split. Number of share after share split. D into E. D into E. 105. If you present like this, nobody has the guts to deduct marks. Okay.
Number of shares.
Multiply these two. 5.25 into 20. 105.
Achha.
105 lakh shares.
Of 5 rupees each.
Yes. Of 5 rupees each. Of 5 rupees each. If you want to write down for your understanding. Now using this number, we will calculate the revised EPS and revised book value per share. So write down our last answer.
कितना बड़ा है?
Revised book value per share and revised EPS. Revised book value per share. Very lengthy question, but it's okay. Revised book value per share and revised EPS. Write down. There is no choice.
20 marks.
20 marks. Maybe now they will not give 20 marks. They will give only suppose 12 marks or 14 marks.
Theory भी आते हैं.
Yes. And one theory question of 5 marks they will add. So 15 plus 5 probably. Right hand side amount or just draw one table. Point A, write down number of share after bonus and stock split as per step 8. 105. Combined earning. Combined earning 160 not change. Bonus and stock split will not affect earning because there is no new capital introduced in the business. There is no outflow of capital also. It is just a accounting impact, no real impact.
Presentation.
Yes, numbers will change, face value will change, but the total capital employed remains the same. Then write down revised EPS. Revised EPS will be B upon A, rupees 1.52. Rupees 1.52. Then write down point D, combined net worth. Again we have done it, it will not change. Only face value and numbers will change. Reserve will get converted into share capital.
Yes, sir.
But your total net worth will remain same. Total net worth will remain same.
15.2.
Total net worth will remain same. Because of bonus and stock split, they will not change. So 1600. So 1600 divided by 105.
15.24.
15.24. 15.24. Right? Enjoyed?
Yes, sir. ये आना चाहिए sir. Exam.
This should appear in the exam.
15 marks.
I also hope.
Bonus.
One last question on merger we will take. Very small question. Question number 4. This question was first asked in November 14 exam for 5 marks. And there was a similar question, not same, similar question in May 22 exam. This question has a concept, okay, which will be very useful to everybody. So come to question number 4. It has a new concept now, which is true cost of acquisition. Are you ready? Everybody will say yes. Then I will go ahead. Yes. So let us read the problem. Elron Limited plans to acquire Doom Limited. The relevant financial details of the two firms prior to merger announcement. This is individual figures. Elron is price 50, Doom price 25, number of share 20 and 10. So market capitalization will be how much? 50 into 20.
1000.
Market cap is 1000.
Lakhs.
And here market cap is
250 lakhs.
250 lakhs. Understandable format? Right. The merger is expected to generate gain which will have a present value of 200 lakh. So if the two companies merge together, the market value of the merged entity together will increase by 200 lakh because of synergy benefit. Because of synergy. Synergy benefit means additional benefit due to merger. Sales will increase, cost will reduce, market share will increase, bargaining power as a group goes up, and the exchange ratio will be 0.5. So how many shares will be issued? 10 into 0.5. 5 lakh share will be issued. 5 lakh share will be issued. 10 lakh into 0.5. 5 lakh share will be issued. So what will be the number of share after merger? 20 lakh plus 5 lakh share issued.
Yes, sir. Yes, sir.
So my question to this batch of talented student is, what will be MPS after merger? MPS will be total market capitalization divided by total number of share. Calculate. Calculate 1000 plus 250 plus 200 and divide by 25. 1000 plus 250. So how much is the answer?
58.
58 will be market price after merger. 58 will be market price per share after merger. When synergy gain is also given, add that also. What is this is the important question, underline true cost of merger from the point of view of Elron Limited. True cost of merger. How much is the true cost? True cost, some student will say they have issued 5 lakh share and the market price after merger is 58. This is the cost. The answer is not this is the cost. क्या हो गया? 5 मिनट. So I am going to give you how to solve question of true cost of merger, and I am going to explain also. Write down. Please write down. The reason for writing it down, if they change the question in the exam slightly, you should be able to handle. True cost of merger. How much is your extra cost you are incurring by acquiring the target company? So step 1, write down. These are the steps. Then we will solve this question. This is theory part. First write down, first step 1, compute synergy gain. Synergy gain, which they have in the problem already given 200 lakh. Then step 2A, write down. Step 2A. Step 2A. Compute theoretical post-merger price. बाद में we'll write down everything later. This is just a theory. How will you compute the post-merger market price? Market value of first acquiring firm plus market value of target firm plus synergy gain. Divide by, this is divide by number of shares of A plus shares issued to B. Number of shares to A plus shares issued to B. Now write down step 2B. Step 2B is the value of consideration. This is what you are paying to the target company. Value of consideration. Step 2A. Step 2A means this price multiplied by number of share issued. Multiplied by number of share issued. So you will get the value of consideration. Value of consideration. This is what we have paid. Less market value of B. This is what we have acquired. This is what we paid. This is what we acquired. So the difference between these two, what you paid versus what you acquired, is called true cost of acquisition. Is true cost of acquisition. If you have paid more than what you acquired, there is a cost involved, extra amount you have paid. You have paid to a company more than what it is worth in the market today. That is called true cost. 2B minus 2C. And if they ask you, what is the net gain to the acquirer company? What is the net gain to the acquirer company? This is the synergy benefit they get, minus this is the cost of acquisition. So difference between step 1, this is synergy gain, minus cost that you incurred. That difference is the net gain, which can be positive, which can be negative also. If you have paid a huge premium, huge amount to acquire the other company, yes, which many companies do also in real life, so they don't have a positive net gain, rather they have a negative net gain. But this is not asked in the question. This is for future exam. Okay. Now come back to the question. Just 3-4 lines and the answer is over. Step 1, write down post-merger MPS. Post-merger MPS formula. Market value of A for acquiring company, Elrond, plus market value of B for Doom. Instead of B, you can write Doom. Instead of A, you can write Elrond, plus synergy gain, divided by shares of Elrond, plus shares issued to Doom, plus shares issued to Doom, plus shares issued to Doom. One line blank equal to question in front of you, 50 into 20 market value of Elrond, plus 25 into 10 market value of Doom, and plus 200 synergy gain given in the problem, upon 20 shares of Elrond, 10 into exchange ratio 0.5 issued to Doom. So the answer is 58, as we had already discussed. 58 is right. 58 is right. Okay. Now write down our step 2, which is the question. Calculation of true cost of merger. Calculation of true cost of merger. Right hand side, rupees in lakhs. First point A, step A, synergy gain. Synergy gain they have given in the problem 200. Step B, capital B, small a, or you can just write whatever you want, A, B, C, D, E, F. post merger market price 58. Post merger price 58. Step capital B small b, value of consideration. Value of consideration. You have issued shares whose worth is 290. You have issued shares whose worth is 290. Correct? You have issued 5 lakh share at post acquisition price 58. The value of the share is 290. Now write down less MVB, market value of DOM, which is 250. 250 is 25 into 10. You are acquiring a company whose market value is 250 by paying a consideration of 290. How much more did you pay? You are acquiring a company of 250 by paying 290. How much more did you pay? Come on. 40. That is the answer. Compare these two. Many times student compare 290 and 200. That is wrong. So 40 is the true cost of acquisition. 40 is the true cost of acquisition. Step 290, just write down 290 minus 250. 40. And if they ask you what is the gain, the gain will be total synergy gain is 200. 40 you have transferred to other company. If they ask you what is the gain to acquiring company, if they ask you what is gain to acquiring company, then you will write 200 is my total synergy gain. Out of that 200 synergy gain, 40 I have shared with the target company. So acquiring company will also get 160 benefit in this deal.
Yes, sir.
Okay. One query from a student.
So
please wait.
The value of consideration wo wala part.
Value of the consideration means
why we have taken post
because
merger price.
Why we have taken post merger? Because this is what my total market capitalization would be after merger. And in that market capitalization, what is the stake of target company? Because this 200 I have considered in the post-merger market capitalization. Yes, this is the value we are sharing with target company in that post-market capitalization. So that is why we have taken post-merger market price. And this is what is left to us. This is the benefit that is left to us. So that is how the companies will do the calculation. How much is the benefit of acquiring the other company? Is it right? Net benefit of acquiring the other company. If you're acquiring other company for a benefit of 200, but out of that 40 you are sharing with them, so you are only going to get 160 in that increase in market capitalization. Okay, so this answer is over. Now we'll continue tomorrow. So dear student, as already mentioned, we are starting a test series. From 13th, you can appear any test anytime from anywhere. You have to register on our website vinod.in, and we will send you the test series on your mail. You will write it, take the photo, make PDF and email us, and we will check the answer and send it back to you. There will be 4 tests for SFM and 4 tests for FR. I will be setting the paper and checking the paper also. On our Vino app, I have also uploaded one subject, FR revision in English. FR revision in English. I will also upload FR revision in Hindi. The price is 2000 rupees right now only, including the study material. Hard copy of study material will be mailed to you. So in case if the student wants to purchase FR revision, he can directly go to our Vino app and you can register there. The lecture will start immediately and you'll get the notes in the form of booklet in 2 to 3 days by courier. Okay. So thank you very much. See you tomorrow at the same time, 9:30.
Yes, sir. Purely.
Happy Holi to everybody. Enjoy your day. You should study also.
Hello, good morning everyone. Today's topic is very important. It is foreign exchange exposure and risk management. So in short, we will call it Forex. Okay. This topic is highly relevant for the exam. You will score about 10 to 20 marks from this topic in the exam. Some exams are even having a higher weightage on this. It can go up to 20-25 marks also. So I have selected some of the important questions from last few years exam, RTP, MTP, and similar type of questions are expected for Forex in the coming exam. So are you ready? Yes. So first question is from July 2021 exam for 6 marks, and we can see this question in the October 22 MTP also for 6 marks. So after MTP, the next destination is exam. So the question is Mr. Mamen, an Indian investor, invest in a listed bond in USA. Underline, who is the investor? Indian. Where he has invested? In USA. Okay, a similar question was asked earlier also in the exam, that is May 2012 exam, long back. Similar question was asked. So if the price of the bond at the beginning of the year is $100 and it is USD 103 at the end of the year. Okay, so beginning value 100, ending value 103. So what is your capital appreciation? $3. Capital appreciation is $3. The coupon rate is 3% payable annually. 3% on which number? 100 or 103? 100. So the coupon will be 3. This is coupon. This is your capital gain. So total appreciation in dollar term is 6%. Total profit in dollar terms is 6%. Do you agree? If you agree, write down yes. Say yes. Find the return on investment in terms of home country currency. This is the important question. Find the return in terms of home country currency. That means in rupee terms, what is your return in percentage? If USD is flat means no change in exchange rate. USD is flat means no change in the exchange rate. Understood? Then second question is USD appreciates during the year by 3%. So dollar rate appreciates by 3%. Then what will be your return? And the reverse question, dollar depreciates by 3%. What will be the return? Indian rupee appreciates during the year by 5%. Suppose Indian rupee appreciates by 5%. Then what will be your return? Will your answer differ if Mr. Mamen invests in the bond just before the interest payable? Will your answer be different if you invest in the bond just before the interest payable? Even if you invest just before the interest payable, you'll get $3 interest, $3 capital gain. So total return will remain. Come on, same. So the answer is total return will remain same. Doesn't matter which. Will your answer differ if Mr. Mamen invests in the bond just before the interest payable? As long as you are getting $3 interest, $3 capital appreciation, your return remains $6. Your answer will not change. If you don't receive the interest, if you invest after the interest payable, then only you have to get capital gain. But if you are getting interest also, then the answer will not change. Understood? So first answer is very easy. If US dollar rate does not change, the Indian investor will earn 6% only. Because at whatever rate he had invested, at same rate he will get his money back. So the answer would be 6% in the first case. So first write down, this is a 5-mark question, 5 question, 5 marks, 1 mark for each question. So first you write down case 1, US dollar is flat. US dollar is flat. Write down everybody, US dollar is flat. So return is equal to, one is you are going to get interest, and second you are going to get the capital gain, which is the difference between price at the end minus price at the beginning, divide by price at the beginning. My objective is not just to reach the answer, I am also telling you the presentation part. Some examiner, if you write suppose 6% directly, they will not give you marks. They want you to present also properly. I have seen students getting different marks because of difference in presentation. So write down 3 plus 103 minus 100 divided by 100. The answer is 6%. So there won't be any difference between this and Indian rupee return. This return in dollar and return in rupee will be same if the exchange rate does not change. But now your intelligence will be tested in full public view. Full public will check your intelligence today. If USD appreciates during the year by 3%, if USD appreciates by 3% during the year, now I am asking this question to this whole batch, face to face and online student, what will be the final answer? What will be the final answer? Final answer, yes, come on everybody. You are appearing for the upcoming exam, you should be able to solve such basic question of SFM, basic question of Forex. Yes, waiting for your reply. If the US dollar appreciates during the year by 3%, what is the return an Indian investor will get? Yes, reply please. 9 point something. 6% you are getting because of the capital gain and interest, and dollar is also appreciating, so you will get more rupee when the dollar appreciates, when you are converting dollar into rupees. So the answer will be something more than 9%, not just 9. So write down the answer. In that case, return will be 1.06 into 1.03, because this 3% appreciation will be applicable not only to the principal amount but also to interest and capital gain portion also. So the answer would be 9.18%. One Mr. Rishabh has got it right. You also got it right. Very good. What is your name? Ajinkya has also got it right. 9.18%. Now I am going to prove this in case if you are interested. Are you interested? So if you are interested, not required for the exam, but for learning. Otherwise, some students could have answered 9%, 6 plus 3. That is not right. Now let us say the exchange rate today is rupees 80 per dollar. So what will be exchange rate after 1 year? 80 plus dollar has appreciated by 3%. 82.40 rupees per dollar. What was the amount invested today? What was the amount invested today? $100 you have invested at the rate 80. So you have invested 8,000 rupees. And how much is the amount received after 1 year? You will receive $106 at the rate 82.4. So can you see this 2.4 extra is applicable to 6 also. So please multiply 106 into 82.4. 106 into 82.4. 8734.4. 8734.4. So 8734.4 minus 8000 divided by 8000 is equal to how much? Exactly, you are getting 9.18%. Exactly, you are getting 9.18%. The student who are interested can note down the proof. If you are not interested, go ahead. So very good Rishabh, very good Ajinkya. Let us go to the next question. Please reply now. Write down, if USD depreciates during the year by 3%, reverse question. If USD depreciates during the year by 3%, yes, come on, reply. Anybody wants to reply? Yes, please reply. Waiting for your answer. You are a student for the exam. You should be able to solve this kind of question. So this time you will just take reverse. Instead of taking 1 plus 0.03, you take here 1 minus 0.03. So the answer is approximately 2.82%. 2.82% is right. Very good. 2.82%, Sidana is right. 2.82. So dollar depreciation is not a good news for the investor in USA. Is it right? He gets lower return. As a patriotic person, you will say, yes, I am happy, dollar is depreciating, rupee is appreciating. But the investor who has invested in USA, he will feel sad. Okay. Next, Mehul is also right. Fourth number question. Let us see who will give the answer right. Indian rupee appreciates. Write down, Indian rupee appreciates during the year by 5%. Indian rupee appreciates during the year by 5%. Please reply the final answer. Yes, please reply the final answer. This time it is not dollar which is appreciating. It is rupee which is appreciating. It is rupee which is appreciating. Rupee is appreciating means dollar is depreciating. Rupee is appreciating means dollar is depreciating. Yes, I am waiting for the answer. Yes, come on student. I don't want 95% answer. I want final answer. One student saying 0.95%. Okay, let me check. 0.95%. One person has replied. I have to check. So you will write 1.06 is your return. Divide by, in this case you will divide by 1.05. When rupee is appreciating, but the rate is given as rupees per dollar, you will have to divide by 1.05 and minus 1 so that you will get a lower return. As an investor, dollar is depreciating means we will get lower return, but the appreciation is given not in terms of dollar but in terms of rupees. Is it right? So you will get the answer as 0.952%. 0.952%. 0.952%. Garg has got it wrong. Sidana has got 0.95, but I am not sure whether you have done by this method or some other method. Now some students who are not satisfied, I will solve it by other method also. Is it right? Suppose you don't know whether you have to multiply or divide, then you can simply say spot rate, assume 80 rupees per dollar, which is equal to 1 by 80 dollar per rupee. Do you agree? Okay, 1 by 80 is how much? Just take on your calculator. Point something. 0.0125 dollar per rupee. So what will be the rate after 1 year? Rate after 1 year. Rate after 1 year will be 0.0125. No, rupee is appreciating, na? If rupee is appreciating, it will get more dollar. So plus 5%, because appreciation is given in rupee. Appreciation is given in rupee. So the answer is how much? 0.01312 $5 per rupee. Now this you can convert into rupees per dollar. Take 1 divide by 0.01325. 76.19 rupee per dollar. Amount invested today. I am explaining the logic. Amount invested today will be $100 into 80 rupees 8,000. Amount received after 1 year will be 106 into 76.19. How much is that? Please reply. 106 into 80.14. So the return in percentage will be, take 8076.14 minus 8,000 and divide by 8,000 into 100. 0.95 1 something. That is, we have rounded off in 2 digits, 3 digits percent. It is matching with this answer. Suppose you don't have so much time in the exam, only write this much. Okay, in case if you are confused, then follow the long process. But you must get it right. You must get it right. Institute has given an answer which is wrong. Why it is wrong? They have said 5% rupee appreciation is equal to 5% dollar depreciation, which is not correct. 5% rupee appreciation is not equal to 5% dollar depreciation due to change in the base. This is called change in the base effect. 5% rupee appreciation is not equal to 5% dollar depreciation. So you have to solve in a different way. So Rishabh has also done in the same way and his answer was right. So now the last answer write down first and then we'll take queries. Will your answer differ if Mr. Mammon invests in the bond just before the interest payable? So write no. No. Our answer will not differ. Presentation is equally important. Our answer will not differ. Our answer will not differ if Mr. Mammon invest in bond just before the interest is payable. Just before the interest is payable, because he's going to get interest also, he's going to get capital gain also, and we will assume that the exchange rate will change as per the question. So this important question is over. Students normally make mistake in the fourth part and they don't understand the fifth question only. So out of 5 you may get 3 marks easily, but last 2 questions you have to practice. So now we'll go to next question number 2. Are you ready? Yes. Now see the importance of this question. You just mention in your notes, this was asked in November 16 exam for 5 marks. One student is asking whether X interest or some interest logic will apply in the previous example. Good question. The answer is question is silent. If you are going to receive interest, then my answer will not change. But if you are not going to receive the interest, answer will change. So we have to assume that the bond is purchased on cum interest basis. We have to assume that the bond is purchased on cum interest basis, so you will get the interest also. Anyway, you are going to get interest. Question number 2, very important question again, and if you have not practiced it before going to the exam, you can make a small mistake here. So this question write down important. November 16 exam, May November 22 RTP. Now just waiting for the next exam. Okay. On 3rd April 2016, a bank quotes the following. What is the date? 3rd April 16, and who has given this quotes? The bank. So first and second question are fundamental basic question on rate understanding, appreciation, depreciation understanding. Then we'll take advanced version. Spot rate for $1 66.2525, this is buying rate. 67.5945, this is sell rate, ask rate. All of you know the higher rate is the ask rate and the lower rate is the buy rate, bid rate. Now understand, this is a very fundamental question. 2 months swap point is given. 2 months swap point means you have to find out the rate of exchange after 2 months, forward rate after 2 months, and they have given you 70-90. That means this 70-90 are premium or discount. I am asking you a question, kindly reply. If the swap points are given as 70-90, whether these are premium points or whether these are discount points. Premium. Why premium? Why premium? Because they are in ascending order. They are in ascending order. Very good. Yes. So if the number written points for ask rate is more than points for buying rate, the dollar is trading at a premium. Same thing applies here also. 3 month swap point is in ascending order, so dollar is at a premium. So in 30 days time, the premium has gone up by, in case of buying rate, in 30 days time, the premium has gone up by how many points? 90 points. And in case of ask rate, the premium has gone up by how many points? 96 points. The premium has gone by 96 points. Mehul is right, Preeti is right. Very good. I am happy that you have understood the basics. In a spot transaction, delivery is made after 2 days. Assume the spot date is 5th April. This is 3rd April plus 2 days, 5th April. Assume one swap point is 0.0001. So 70 swap points will be 0.0070, 0.0090. In fact, this the student should know, but institute is very kind. Okay, so they are helping you. They are helping you. So the swap points are actually 0.0070 and 0.0090 for the 2 months period. And same thing for 3 months period. You are required to ascertain swap points for 2 months and 15 days. Oh my God. You are given swap points for 2 months, 3 months, but they want you to find out the swap point for 2.5 months. So 2 months is already 70 and 90. In 30 days time, the swap point has increased by 90. So in 15 days time, it will be half. Similarly for this also half, 48. So the swap point for 2.5 months will be 115 and 138. If you know this basics, you can solve. Otherwise, you will not be able to solve and you may lose 5 marks. 5 mark questions are usually compulsory questions. Oh, you can't skip it also. Okay. And the next question is, determine the foreign exchange rate for June 2016. So I will take the spot rate. I will add the premium. I will get the exchange rate for June 2016. Very good, Sidana. Compute the annual rate of premium or discount. Annual means you have to annualize. Your question is of 2.5 months, but you have to answer in per annum terms. Premium or discount. This is premium of US dollar on INR on an average rate. Underline average rate. Average rate means spot rate plus forward rate divided by 2. Is it right? So how much is the premium on average rate? So premium divided by average rate into 12 divided by 2.5. Why into 12 divided by 2.5? Because we have to annualize it. This much premium is for 2.5 months. So what is for 12 months? Okay. If you know the basic, this question 5 marks is in your pocket. So let us solve one by one, step by step to get full marks. Step number 1. First question is ascertain the swap points after 2 months and 15 days. Write down. Come on, step 1. Calculation of swap points. Calculation of swap points for 2 months and 15 days. Calculation of swap points for 2 months and 15 days. So under that write down, right hand side 2 columns, bid rate, ask rate. Any other presentation is also welcome if institute can understand your answer. So first you write down swap points for 2 months. Swap points for 2 months, question in front of you, third line, 70 points, 90 points. Then below write swap points for 3 months. I am explaining to you that in such problem you have to first find the difference and take proportionate change in the point. So 160, 186, both are given. Okay, now we will write Swap points for 30 days. Swap points for 30 days. That is the B minus A. B minus A. The student told me B minus A. Wow. Amazing. Huh? Now you have also understood the presentation 90 and 96. But we want the swap points only for 15 days, not for 30 days. So I will take C divided by 2. C divided by 2. Come on, student. Is it 45 points and 48 points? So I have to answer swap points for 2 months and 15 days. This is 2 months plus 15 days. Write down point number E. Swap points for 2 months and 15 days. Swap points for 2 months and 15 days. Is A plus B 115 and 138. 115 and 138. 115 and 1 mark. You will get 1 mark. Okay, enjoy 1 mark. If you want 1 mark, this must be right. If that is right, then next answer will be right. Step 2. Step 2. Exchange rate. Forward exchange rate. Forward exchange rate on June 20, 2016. Forward exchange rate on June 20, 2016. Right hand side again 2 columns. Bid rate, ask rate. Bid rate, ask rate. Bid rate, ask rate. First write down spot rate. Question in front of you, second line. Read the second line, you will find 66.2525. 67.5945. Then write down point B, add swap points. Why swap points is added? Because it is at premium. Ascending order means premium. So you will add 0.0115. 1 point is equal to 0.0001. So 115 points will be 0.0115. 0.0138. Now tell me the total. Do the total and write yourself. That will be your second answer for 2 marks. Yes, Rishabh has answered 66.2640. Very good. And 67.6083. Amazing. Wonderful. This is right. Now, step number 3. Calculation of annual rate of premium on average rate. Very easy. Premium we have already calculated. That premium amount we have already calculated. Average rate means spot rate plus forward rate. Because that is only possible average rate. Spot plus forward. Divide by 2. Again write down 2 columns. Heading write down first. Answer of part 3. 2 marks for this much effort. Calculation of annual rate of premium on an average rate. Underline the word average rate. In your exam they can give spot rate. So be careful with this wording. Bid rate, ask rate, 2 columns. First write down spot rate. Given in question, second line. Spot rate. Spot rate is 66.2525 and 67.5945. Then write down forward rate. Then write down forward rate. 66.2640, 67.6083 Now write down average rate. Average rate, because the question has asked average rate. Average rate will be a plus b by 2. On your calculator, a plus b divide by 2. 66.2583. Anybody for the next column? Ask rate. Ask rate. Ask rate. Ask rate is 67.6014. Very good. So this is my average. So this will be the base for calculating the premium in percentage. Very good. Now write down premium in bracket as calculated in step 2. As calculated in step 2. So that was 0.0115. Can you see that? 0.0138. 0.0138. So now you write down annualized premium percentage. Annualized premium percentage. So how do you get it? This is your premium. Divide by this. But that will give you premium for 2.5 months into 12 divided by 2.5. So I'll give you the formula for this if you want to write. D by C into 12.5 divided by 2.5 into 100. Into 100. So that is 0.0833%. 0.0833% and 0.098% and 0.098%. Is the answer right? Everybody please reply yes or no. Is the answer right? Is my calculation right? 0.098. Yes, please reply. Is it right? Can we go to the next question if you agree? 5 marks. But the problem is many students don't know how to get the swap points when it is given between two dates. So you have to count the number of days, check how much is the difference and calculate proportionately. So now we'll go to another question number 3 from July 2021 exam. Write down important. This question has come in RTP, MTP also. I have not mentioned the date for RTP and MTP, but it was there. This question is based on early delivery of forward contract. This question is based on early delivery. First let us read and then we'll discuss, then we'll solve. Very important. Have you marked it important? Another question where the student needs pre-practice, because in the exam you can't handle it. First time if you are solving, there are rules of solving question of early delivery. The rules are given by a body in India called FEDI, Foreign Exchange Dealer Association of India. They regulate the foreign exchange market. Okay, to practice this question before you go to the exam. In fact, I will say practice all questions which I have given in this session, revision session for exam purpose. On 1st October, underline the date 2020. Mr. Guru, Hoja Shuru, Mr. Guru, an exporter. Again underline the word exporter, because your answer will change completely had it been importer. As a practice you can try it for importer, okay. As a homework you just change it to importer and your answer will change. Enters into a forward contract with the bank to sell, underline to sell means the exporter will sell dollar to the bank. If exporter will sell dollar to the bank, what will bank do? Bank will buy dollar from the exporter. Bank will buy dollar from the exporter. And what is the rate at which they have agreed? 1 lakh dollar. The date forward contract will be executed 31st December. That means how many months? 3 months. And at what rate? 75.40. Very easy question. These are the important parameters I have to keep in mind. Then what happened? However, at the request of the importer, Guru has an importer in foreign country USA. That party importer, let us call him Mr. Biden. Okay, let us call him Mr. Biden. Mr. Biden, who is a customer of Guru, Mr. Guru received the amount on 30th November only. Such a nice customer. He paid, instead of 3 months, he paid in 2 months. Happy. Guru is happy that I received the payment 1 month before the due date. But the forward contract was taken for 3 months. So what he will do with that $1 lakh now? He will have to go to the bank and request the bank, sir, please accept this $1 lakh at forward rate. The bank will say, okay, I will accept. But whatever are the losses that I will suffer, you will have to compensate. Is it right? Are you willing to compensate? You say yes. Yes. Then we are going to accept the early delivery. Is it right? So the question is how that gain or loss will be calculated by the bank, which Mr. Guru will have to pay to the bank. Right. Now you have understood the concept? Okay, one student is saying Guru is Modi ji. You are right. They cannot write the name directly. So Guru, Vishnu Guru. Okay. They should have written Vishnu Guru, self-declared Vishnu Guru. Now Mr. Guru requested the bank to take delivery of the remittance on 30th November 2020, that is before due date, 1 month before due date. 1 month before due date. The interbank rate means the rate at which one bank buys or sells to the other bank. That is called interbank rate. The rate at which banks deal with each other. So this bank will become a customer for the other bank. This bank will become a customer for the other bank. Okay, that is interbank rate. On 30th November 2020 was as follows. Spot rate 1 month forward premium 10.15. Ascending order means again premium. Anyway, they have written premium, so say thank you to the institute. Assume 365 days in a year. We need to do some interest calculation in this problem. That is why they mentioned about days. If bank agrees to take early delivery, then what will be the net inflow to Mr. Guru? This is my question. Sometimes students don't know what is the question. Question is what will be the net inflow to Mr. Guru? Net inflow to Mr. Guru will be 1. He is going to get $1 lakh multiplied by 75.40. But he has to pay some charges to the bank. So the answer is 1 lakh into 75.40 minus any charges which is going to be levied by the bank. Okay, so that will be the answer. Some student only write 1 lakh into 75.40. Then out of 8 marks you will get 0.25 marks, which will be rounded off to 0. Okay. Assume that the prevailing prime lending rate is 18% per annum. This will require interest calculation also, because the bank will have to execute the transaction 1 month before the due date. So there will be some net inflow and outflow to the bank. Bank will buy from the exporter and bank will sell in the spot market to another bank. Bank will not keep $1 lakh. Banks are just intermediary. They buy, they sell. They don't stock foreign exchange. Of course they may be, but for our calculation purpose, as per FIDI rule, the bank will sell at the spot rate to the interbank, and the difference between the rate at which it will buy and the rate at which it will sell. So there is an inflow and outflow. That inflow and outflow happened 1 month before the due date. On that, interest at 18% for 1 month will be paid. But we'll calculate in days, which will come to 30 or 31. We'll check. No problem. Plus, there will be a swap charges also. Plus, there will be a swap charge. What is swap charge? When Mr. Guru came on 1st October to sell dollar, simultaneously bank also enter into a forward sale contract with the interbank, because they banks know when Guru will sell dollar to me after 3 months, I will also sell to some interbank. Guru will sell after 3 months to bank. Bank also will sell it to interbank. Now bank has also entered into a forward contract. That also needs to be cancelled. So that is why the bank will have to cancel the previous forward contract by entering into a 1 month forward contract. Right? And because of that, if there is any loss to the bank, Guru will have to pay. Right? So the question is, if this is one question which normally we teach in the classroom, but institute is also smart. They have added one more question. If Mr. Guru can deploy these funds in USD, if Guru can deploy these funds in USD, suppose Guru will tell the other party, Mr. Biden, don't send me money now. I will invest in USA only for 1 month. And after 1 month I will bring. Possible? Why to bring money 1 month in advance? You can keep it there in some bank and bring it after 3 months and convert at the forward rate that you have agreed. Okay? He gets a return of 3% per annum. But if he keeps money there, he will get interest also for 3 months. 1 month, you are right, 1 month. Which is better? Which is better means, should he receive the money today or should he receive the money after 3 months? Okay, so that is another good question they have added. Now, in order to understand such question, we will first make a summary of transactions which have happened in this problem, and we will look at the question from bank's point of view. Okay, right. Write down the question. I am going to present in a summarized format. What are the transactions that are happening, and from whose point of view? Bank's point of view. Okay, how will the bank look at all these transactions? Please write down. Write down the heading, summary of transactions, and you will find it very easy. This summary gives you a snapshot of all transactions, very easy for understanding. Institute's answer does not contain this summary. This you will write in the exam if you have time. If you don't have time, directly solve the answer. Are you ready? Yes. 3 columns we will draw. First column date, second column transaction entered by bank with the customer, and transaction entered by the bank with interbank. Okay, so write down date 1st October, 1st October, what is the transaction entered into by the bank with the customer? The bank has agreed to purchase $1 lakh. Exporter wants to sell. So bank wants to purchase. Write down, with customer, bank has entered into a forward purchase $1 lakh at 75.40 due on 31st December. So what bank has committed? Bank has committed to the customer that I will buy $1 lakh on 31st December at the rate 75.40. Now understand, if a bank enters into a forward contract with the customer, bank also enters into a forward contract with interbank, so that on maturity after 3 months bank don't have any risk. Is it right? So what contract bank will enter into with the interbank? Forward sale. So bank will simply think like this: I will get $1 lakh from the customer after 3 months and I will sell it to the interbank. So usually the difference between these two rates become the profit of the bank. That means without any effort, only you are doing as a middleman, buy from one party, sell it to another party and enjoy the difference. This rate is not given, so I have not written the rate, but the transactions will be covered like this. Date is wrong. You are right. So I am going to change the date. Sometime while making presentation, we also make mistake. We are also human beings. We have not come from planet Jupiter. Okay. So it will enter into forward sale $1 lakh due on 31st December. If everything would have gone as per the plan, then bank will buy from customer, sell it to the interbank, and the difference in the two rates will become profit to the bank. This rate is not given, not required also. Ask one query. One student wants to ask a query. Come on. No, that we will see on this date. Now this rate is given on 30th November. On 1st October, interbank rates are not given. Not given, not required also. Rate on 1st October with interbank not given, not required also. That rate we don't require. That is not customer's job to find out at what rate you have entered into a contract with the interbank. You will come to my office and you will say, sir, I want to purchase this book. I will also purchase from somebody and sell it to you. Are you interested in knowing at what rate I have purchased? No. And customer is not responsible also. That is your business. How do you arrange your transaction is your business. Okay. Come on, next. Let us move fast now. On 30th November, customer comes to the bank and requests, sir, please take $1 lakh. The bank will say, okay, come on, I will take $1 lakh at the agreed rate 75.40. Bank will purchase at the same rate. Don't worry, write down. But what will bank do with this dollar? First you listen to me. First let me complete the whole story. Bank will purchase $1 lakh at the contractual rate from the customer. As I have told you, all these calculations are done as per FEDI rule. Okay, so some doubts you may have, but forget it right now. And this is correct also, logically. Customer will sell dollar at agreed rate. But then what bank will do with this dollar now? It will sell in the spot market. Bank will sell in the spot market. Now do not ask query what if bank does not sell. All those are hypothetical questions. For calculation of charges to be levied on the bank, I will take spot rate. Okay, which spot rate will you take now? That is another query. This bank will sell. Interbank rate will buy. Interbank will buy. Now this bank is like a customer to the interbank. Yes. So the interbank will buy, so will apply the lower rate. The lower rate is 75.22. Here again, scope of accident is there. Somebody can take 75.27. Okay. We have to take the rate quoted by interbank. But this contract which the bank had entered into will remain open. So that contract also has to be cancelled now. Now this customer will not come on 31st December. He has already closed his transaction. So I need to cancel it. How do I cancel it? I will enter into a reverse contract with interbank. To cancel the forward sale contract, I will enter into a forward purchase contract. Write down point number E. Forward purchase $1 lakh. At what rate we will take? Now this bank is like a customer to the interbank. It will purchase, but interbank will sell. So you have to apply the selling rate, ask rate. Now the student is asking, how did you get 75.42? So in case if you are interested, you can write 75.27 and margin is 0.15. Is it right? Not googly. These two contracts are reverse. If you enter into a forward purchase, how do I nullify it? By entering into a forward sale, reverse. So that after 3 months, I don't have any risk now. On 31st December, I will purchase $1 lakh and I will sell $1 lakh. So I don't have the risk on 31st December. This is how the banks manage their foreign exchange risk. Is it right? They will not keep the exposure open because then anything can happen after 1 month. After 1 month, Russia can be defeated by Ukraine. Okay, Germany can also join the war. So this is my presentation, and one more line write down 31st December. 31st December, what will happen? Customer transactions are complete, but with interbank I will purchase $1 lakh under contract E and I will sell $1 lakh under contract B. So with this my entire transactions will get complete. It seems from the face of a student in the classroom he has not studied this chapter before. You studied. This portion is very complicated. You are right. I am also sometimes confused. And I am assuming many other students will also be getting confused in this. It takes time to think, and thinking is one of the most difficult tasks on this planet Earth. And in exam time it is even more difficult. You are right. So now what I'll do, I'll just give you an explanation and then we'll solve. Customer comes on 30th November. Bank purchase dollar. So this is outflow of cash. And bank sales. This is inflow. So the difference between C and D is the net cash flow, actual cash flow happening here. And if it is outflow, interest will be charged at the rate of 18%. If it is inflow, bank will pay interest to the customer for 31 days. Okay. So one thing we have to compute is the interest. Interest will be on actual inflow and outflow. And because the customer comes to the bank for early delivery, the bank has to enter into these two extra contracts. So the difference between these two rates is called swap difference. It's called swap difference. Swap difference is between point number D and point number E. Because the customer comes to the bank for early delivery, bank had to sell at this rate and bank had to purchase at this rate. Bank had to purchase at a higher rate than the rate at which it sold. So swap charges will be levied upon the customer because the bank suffered loss due to early delivery. Interest charges will be levied upon the customer because there was a net outflow of the bank 1 month before the due date. So these are the two charges the bank is going to levy on the customer. Right. Step number 1, calculation of interest. Calculation of interest. Mehul is saying very complicated question. Yes. But if you practice 2-3 times, then you will get it. There are a lot of rates given in the problem, and that is the reason for confusion. Which rate should be used when? Which rate will be used for interest? Which rate will be used for swap charges? So the two inflows and outflows are understandable. That is interest. And the two contracts which bank had entered into extra is the swap loss or gain. Okay, that's it. Let us go to the calculation part. Please write down calculation of interest. Right hand side rupees. Right hand side rupees. First point A, outflow of fund. Bank will purchase $1 lakh from the customer at 75.40. But the same dollar will be sold to interbank at 75.22. So inflow. Please write inflow. 1 lakh into 75.22. 1 lakh into 75.22. 75 lakh 22,000. So is there net inflow or net outflow? Net outflow. Very good. Net outflow, write down 18,000. Net outflow is 18,000. Now write down point number D. Interest at the rate 18%. So number of days will be 31. In December we have 31 days. Customer comes on 30th November. So from 30th November to 31st December you have 31 days. Don't include both days. Only include 31st December. So tell me the interest. I am waiting for the students to give me interest. Interest, anybody interest? 275.18. 275.18. Now write down step 2, calculation of swap gain or swap loss. Calculation of swap gain or swap loss. Swap gain or loss means the bank had to sell today and buy 1 month forward. Sell today and buy 1 month forward because of customer request to go for early delivery. So the difference between those two rates will be gain or loss to the bank. Yes, very good Mehul, you are right. So write down, look at your table. In your table, point number D and E. Point number D and E. In the table, point number D and E. Bank purchases dollar. Bank purchases dollar at rupees 75.42. And bank sells dollar at what rate? 75.22. Just understand now, purchase rate is more than sale rate. In order to help the customer, The bank had to take the loss, take the hit. How much? 75.42 minus 75.22 per dollar, 0.20 per dollar. So total loss on $1 lakh. Come on, total loss on $1 lakh is 20,000. Is right, rupees 20,000. This will also be recovered from the customer because it is interest to be levied upon the customer. This is also to be recovered from the customer because of swap loss. So the total charges the bank will levy upon the customer will be 20,275.18. 20,275.18. Write down one small working for that also. Total charges. Total charges. Please practice again and again. You will get it. Total charges, right hand side rupees. Point number A, interest. Point number A, interest. How much is interest? 275.18. Very good. Point number B, swap loss. Swap loss. How much is that? 20,000. Point C, total 20,275.18. So this is your charges, and the last answer is net amount payable to the customer. How much net amount bank will pay to the customer? So as we discussed, bank has to pay to customer contractual rate 75.40 into 1 lakh minus, come on, the charges. That was your question. That was your question. Okay. Right. Gross amount. Gross amount. Come on, everybody. Gross amount 75,40,000. Gross amount 75,40,000. Less total charges as calculated in step 3. As calculated in step 3. 20,275.18. So the answer is A minus B, net amount. Point number C, net. A minus B. One student has already replied. Very good. 7519724.82. Presentation is also important. 8-mark question. 4 steps you will write, and the examiner will keep writing 2 marks. 2 marks. 8 marks total. हाँ जी. 18,000 is not the charges to be levied. On 18,000 interest will be charged. The bank, that is not a loss to the bank. The loss to the bank is the swap loss. Because of the early delivery, how much additional amount the bank has to pay? Is it right? Because they are selling and they are buying also, na? So the difference between the two is the loss to the bank. They are selling and they are also buying in forward market for 1 month. That difference is the loss to the bank. On 18,000 only interest will be calculated because there is an outflow 1 month before the due date. Okay. That is a good question. Many students have asked that question in the past. Now this question has one more additional feature. Third part of the question, which normally they don't ask, but this time they had asked. If Guru can deploy these funds in USD, he gets return at the rate of 3% per annum. Which is a better option and why? So write down, if Guru deploys these funds in US dollar, if Mr. Guru deploys these funds in US dollar, then inflow will be, so he will take $1 lakh from the customer and he will invest in USA for 1 month, on which he will get interest at the rate of 3%. So write down first point number A. Point number A, write down receipt of US dollar on 30th November. This is clear. The customer will give him $1 lakh, but he will not bring it into India. He will invest in USA. So on that he will get interest for 1 month, because we have to compute in days. I will take 31 by 365. Add interest for 31 days. Take on your calculator 1 lakh into 3% into 31 by 365. Yes, 254.79 or 80 is right. So what is the US dollar available on 31st December? US dollar available on 31st December. A plus B. 1 lakh 254.79. One lakh 254.79. Now write down point D. Now wait, this time there is a small area of mistake. This entire dollar will be converted into rupees at what rate? For $1 lakh you have entered into a forward contract. So 1 lakh you will multiply by 75.40, but this is extra 254.79. What about this 254.79? Which rate you will apply? So you will have to see on 30th November you will enter into one more forward contract for 1 month. 1 month, not 3 months. 1 month. So which rate you will apply? Buying rate or selling rate? Again you are going to bring the money. So you will sell 75.22 plus the premium on that 0.10. So this will be converted at 75.32. Is it right? So what students do, they multiply the entire amount by 75.40. Another mistake, they don't take 75.32, they take some other figure only. And then you will lose 2 marks. So I will have to apply 2 separate rates for principal and interest. There is no note required. Because there is no choice, na. There is no need to write a note. A smart person will enter into forward contract only. And based on the information available, that is the only possible rate we can use. So write down. First write down sale of US dollar 1 lakh to the bank. Sell US dollar 1 lakh to the bank as per agreed rate. As per agreed rate. For 1 lakh dollar we have entered into forward contract at 75.40. 75 lakh 40,000. And then you write down sell US dollar 254.79. This interest part. How did we calculate that? 75.22 plus 0.10 premium. So we have to use this rate only. Spot rate for 31st December is not given. So the only way to reach that rate is this rate only. Spot rate for 31st December is not given. So we have to take the forward rate for 1 month. Add these two figures. So write down the inflow is equal to, amount of inflow equal to, very good, come on. Add D plus E. Add D plus E. 7559190.78. Now the question is, which is better and why? Here the amount is 7559,190. What was the answer earlier? This is higher. So write down advice. Since cash inflow will be higher, in deployment of funds, option comma, the same would be chosen. The same would be chosen. The same would be chosen. The same should be chosen. But this question has a small mistake. In India, he will get the fund after 2 months. These funds you are getting after 3 months. So comparison is not proper. We should have been given at what rate in India you can invest that money also. Is it right? For 1 month. You have to also consider the interest opportunity for 1 month in the first option if you invest in India, but that is not given to us. Is it right? So whatever is given, based on that, this is the answer. So write down assumption. It is assumed that there is no opportunity cost of funds received in India under first option. It is assumed that there is no opportunity cost of funds received in India under the first option, because comparison is happening between cash flow at the end of 2 months and at the end of 3 months. So 1 month gap is there between the two figures, right? So that was a question on early delivery. Not complicated. What is complicated you will see now. The genuine meaning of the word complicated is question number 4. The source is MTP October 2021. Write down, very important, because this question is based on an amendment which has happened in FEDI rules. Okay. Amendment in FEDI rules. So that is why the institute have given this question. So first you read the problem yourself. Read the problem. I will come in 1 minute. Read slowly, silently. There is some typing mistake here, so please rectify. In your notes probably you will find March, April, May, June is written, but actually it is April, May, June, July. So just rectify it. I'll come in 1 minute. Read the problem, try to solve. Okay, welcome back. This is a question on automatic cancellation, right? Z has to remit US dollar 1 lakh for her daughter's education. Wow, such a caring father. For her daughter's education on 4th April 2021. He wants to remit funds on 4th April. Underline 4th April. This is the maturity date of the forward contract. Right? Accordingly, she has booked a forward contract. Instead of she, it should be he. He has booked a forward contract with his bank on 4th January 2021 at the rate 73.8775. So this is my original contracted rate with the bank. Okay. So bank will sell to Mr. Z, and what bank has done? The bank, from where will bank get $1 lakh? The bank has to also purchase from interbank. So bank has covered its position in the market at rupees 73.7575. Understood? So the logic is that this is how banks operate. After you will qualify, you will also join a bank, and suppose you join the treasury of the bank. This is what you do: buy from interbank at this rate 73.7575, sell to the customer at 73.8775. So the bank was enjoying the profit of the difference. That is what they do when the customer books a forward contract. If they have to buy from the customer, they will buy at a lower rate than the interbank. If they have to sell to the customer, they will sell it at a higher rate to the customer. You are right. The exchange rate for US dollar in the interbank market, interbank underline means one bank is quoting to another bank on 4th, 7th and 14th April 2021 are. All rates are not relevant in solving the problem. Okay, only some rates are relevant, and that is where your intelligence will be tested in full public view. Is it right? The whole world will watch your intelligence today. So these are the spot rates on various dates. Then this is the spot rate. April means for April end, because you will say, sir, we are already in April. So this is for the April end. If you want to enter into a forward contract, if in your book March is printed, you have to make it April, because March is not relevant in our answer at all. Is it right? And then May, June, July. So these are the forward rates basically. These are the forward rates. So you have to choose the right forward rate for solving the problem out of so many. We will see one by one. First read the problem. Lot of adjustments are involved. Then it says exchange margin of, one more concept they have added, exchange margin of 0.10%. What is the meaning of exchange margin? Anybody? When bank sales to customer, the interbank rate plus exchange margin, because that is the profit of the bank. Bank is like a, you can say, retailer, okay. Interbank is like a wholesaler and the customer. So what the retailers do, they buy from wholesaler, they add their margin and they sell it to the customer. So here this bank will purchase dollar from interbank and sell to the customer by adding 0.10%. That is, the FEDI has given a range. Within that range, you can charge the extra amount to the bank. And suppose because of the customer there is an outflow of fund, there is an outflow of fund to the bank is going to charge you interest at the rate of 12%. In earlier problem it was 18%. Next is the remitter. Remitter means whom? Z, Mr. Z. Remitter means Mr. Z. Due to rescheduling of the semester, oh my god, due to rescheduling of semester, has requested on 14th April. When did this fellow come? He should have come on 4th April. Is it right? He should have come on 4th April. But he comes on 14th April. But he comes on 14th April. Such a lazy fellow. Okay. For extension of the contract with due date 14 June 2021. So now he wants the contract should be extended to 14 June because the semester got rescheduled. Now the problem is, these are the 6 questions and the institute will give you 10 marks. 1.5 marks for each question, 9 marks, 1 mark for good handwriting. Okay. That is how they can do. Cancellation rate you have to find, at what rate the contract will be cancelled. Then amount payable on $1 lakh, swap loss, interest on outflow of fund if any. If there is an outflow, bank will charge interest. What will be the new contract rate? So the new contract rate will be the forward rate to be taken on 14th April for 14 June. Forward contract to be executed on 14th April for 14 June maturity. New contract rate and total cost. Total cost means one is your cancellation charges, swap charges and interest charges. So the total of these 3 will be total cost. Is it right? Now one more instruction, rates must be rounded up to 4 decimal places. Means your answer will have 4 digits after decimal and in multiples of 0.0025. Means the last 2 digits will be either 25 or 50 or 75 or 00. Last 2 digits will be in multiple of 25. So you have to round off to the nearest 25 or 50 or 75 or 100. This is how the banks actually operate. Okay. And for interest calculation, you will require it. For interest calculation, take 365 days in a year. So this is a question on automatic cancellation. This is a question on automatic cancellation. Write down. This is a question on automatic cancellation. Since the customer does not turn up on 4th April, bank will wait for 3 days. Bank will wait for how many days? 3 days. That is why 7th April dates are given. Because you are wondering why to 7th April doing here. 7th April bank will wait for 3 days as per the new FEDI rules. And if it does not turn up till 7th April, the bank will cancel the old contract automatically. That is why it is called automatic cancellation. Is it right? If you don't turn up, how much will I wait? I am not a Majnu, I will wait for infinity period for my Laila. I am a bank, you are a customer. Okay. I hope you liked the joke. So write down summary of transaction. Summary of transaction in bracket from bank's point of view. From bank's point of view. So for few minutes you assume you are a bank what are the transactions you will have to enter into. So first write down 3 columns. First column date, second column transaction with customer, and third column transaction with interbank. Okay. 4th January the customer comes to the bank, which is printed in the first paragraph also, for daughter's education, and the contract is for 3 months. So with customer the bank enters into a forward sale contract. Yes or no? Yes, right, forward sale. Then write down $1 lakh, that is quantity. Then write down the rate at which contract was entered, at 73.8775. Then write down due on 4th April. Due on 4th April. Are you understanding? If this question comes in the exam, only if you have done practice before going to the exam, you will be able to solve. Otherwise, just ignore it. Then write down with interbank. Even this is printed in the first 2-3 lines. Forward purchase. This is how banks operate. Tomorrow you will pass and you will also do the same thing. Then you will remember me. Okay. Sale contract with customer, purchase contract with interbank. So what is the logic? Suppose everything goes according to the plan, they will buy at this rate, sell at this rate, whatever is the difference becomes the profit of the bank. And this way they earn lot of profit on such transactions, because every day thousands of customer come. This amount is 1 lakh only. Some customer come with 1 million, 10 million requirement also. Okay. Point number, next write down 4th April. 4th April was the due date. The customer should have come, but he has not come. So there is a default. But what about interbank? I can't default. I am a bank. My reputation is at a stake. Yes or no? You are a student. If you don't come on time, it's okay. If you are absent also sometime, it's okay. But what about me? I have to come on time. I have to come every day, because my reputation is at a stake. So I will have to honor my contract with the bank. So what is my contract with the bank? That interbank. My contract with interbank is that I will purchase $1 lakh on 4th April at 73.7575. So I will take delivery. But then what will I do with this dollar? My customer has not turned up. So I will sell that dollar in the spot market today. I'll sell that dollar in the spot market today. But at the same time, we hope that the customer might come tomorrow or day after tomorrow or after some other day. So I will enter into a forward purchase contract. That is how they do the calculation. Okay. So I will assume that the customer will come in the near future. So I will take the nearest forward contract, which is April, and I will enter into a forward purchase contract, so that if the customer comes tomorrow, day after tomorrow, I can give him the dollar. Is it right? Whenever he comes. But that is how the calculations are done. Right. Point number C, write down. Point number C, write down. This is my contract with interbank. I have committed to purchase, so I will purchase. Take delivery under contract B. Take delivery under contract B. I have committed with interbank to purchase $1 lakh. On 4th April, I will do it. But I will sell it also in the market immediately, because the customer has not turned up. So look at the table, 4th April column, 4th April spot rate. Can you see 4th April spot rate? I'll just go to the question to make you understand. We are on 4th April. Remember, 4th April. The bank has to sell $1 lakh in the interbank market. This bank will be like a customer for the interbank. So they want to sell, the interbank would buy. They want to sell, interbank would buy. So which rate will be applied? Yes, the lower rate, 73.2775 on 4th April. So come back. I hope now you understood why 73.2775 is written. Right. But as per FEDI, the customer has not yet come and the contract is not yet cancelled. So I will keep myself ready for a possibility that customer may come afterwards and ask for dollar. So I will enter into forward purchase due April. So I will take some nearest forward contract. Nearest forward contract is April only. Forward purchase due April. Now what is the purchase rate? If I want to purchase on 4th April, forward contract maturing in April only, I want to purchase, interbank wants to sell. So I will take the selling rate of April forward. Second line of the table, first column. In case if you are not understood, I have to go behind. This rate I have to take, April. Bank will enter into forward purchase contract with interbank. If this bank is purchasing, the interbank will be selling. So I will take higher rate. Okay. Now comes to 7th April. Customer has still not come up, not turned up. So I will cancel this contract. I will cancel the contract with the customer. At what rate it will be cancelled? It will be cancelled at the rate on 7th April. Is it right? So write down cancel contract A. Cancel contract A. A means contract number A. I hope you are writing number also. A, B, C, D, E, F. Cancel contract A at 73.1575. At 73.1575. At 73.1575. But when you enter into a contract with the customer, you will have to adjust the exchange margin also. You have to adjust the exchange margin. So when buying rate is to be used, margin is deducted. When selling rate is used, margin is added. So I will cancel at 73.1575 minus 0.10%. Now your question will be why we have taken 73.1575. Look at the 7th April column in your book. First line, spot rate on 7th April. There are two rates given, 73.1575 and 73.1975. Mr. Z, understand on the screen left side. Now this is the most trickier part. Which rate I will use? The buying or the selling? You are Mr. Z. What was your original position? To buy dollar from the bank, $1 lakh. So Mr. Z will have to take opposite position. Mr. Z will have to take opposite position to cancel. So Mr. Z will have to sell dollar, correct? If Mr. Z has contracted to buy, the contract he will have to enter into is to sell. Buy will be cancelled by sell. Buy will be cancelled by sell. I have not written in bank now, I have written outside the bank. The answer will be same, whichever way you understand, but this is easier. You are Mr. Z, you have entered into a contract to buy. So what rate bank would have applied at that time? Sell rate. Now Mr. Z wants to cancel. So what rate bank would apply now? Reverse, buying rate. So it will apply buy rate. That is the logic. Customer wants to sell means bank wants to buy. Buying rate will be applied. Or look at it from this point of view. When bank sold to the customer, it applied selling rate. When it has to be cancelled, buying rate. So buying rate. I think that is easy. Okay. Bank sold to the customer by applying selling rate. So bank will cancel it by applying buying rate. Okay. So first buying rate logic is clear. Now you are not given a rate between bank and the customer. You are given interbank rate. So that is why bank will give lower amount to the customer when it is buying from the customer. It will give lower rate than what interbank is giving it to the bank. Okay, so minus. When bank will sell, it will apply plus. But when bank is buying, it will apply minus. Okay. Now let us say this is a retailer. Now this basic thing you should know. In revision batches, this should not be asked. This is the customer and this is wholesaler. If customer sells to retailer and retailer has to sell to wholesaler, if wholesaler buys at 100 rupees, at what rate you will buy from the customer? 100 or less than 100? Suppose you go and sell your book to a bookseller. Bookseller will sell to somebody else. So the middleman will always buy at a lower rate, so minus, and sell it to the other party at a higher rate. So what we teach in our basic lectures of Forex, when you are computing buying rate, margin will be deducted from the interbank buying rate, and when you are selling to the customer, margin will be added to the customer. So if you are applying buying rate, deduct margin. Okay. Now come to 14th April. हाँ जी. There is no confusion. हाँ. हाँ.
I got that because पहले हम लोग sell का contract था.
First you have sold, so buy.
But जो rate दिए वो interbank पे थे.
So that is why the margin is adjusted, na? The rates are given interbank. So whenever you are entering into a contract with the customer, the margin will be adjusted. But when you are entering into a contract with interbank, then margin is not adjusted. Okay, now write down 14th April. Write down 14th April. Bank always have an upper hand. You are right. 14th April, now this father of this girl comes and says, now I want to enter into a fresh contract. So this is like entering into a fresh contract. Forward sale due 14 June at 73 point. Can you go to 14th April column? In 14th April column, fourth line, which is June, sell rate 73.7050. 14th April, last column, fourth line, 7050. Can you see that? Fourth line, ask rate and plus margin. Plus margin. Because now you will say, sir, why plus margin? Answer is, when I am taking interbank selling rate, I will add margin and sell it to the customer. Okay. Now, okay. Now let us see the calculation. How do we do the calculation? I'll explain on this table first and then we'll solve. I have not seen any book who is explaining properly the answer why something is done like this. They just simply take this rate, this rate, this rate and do the calculation. So first you understand, on 4th April, there are two inflows and outflows happening. Here you are purchasing at this rate, so there is an outflow. And here you are selling the same thing, so there is an inflow. These two are real transactions where inflows and outflows are taking place. Am I right? So the difference between these two is net inflow or net outflow. If it is net outflow, interest at 12% will be charged. Interest at 12% will be charged. Okay. Now come to these two rates, which are written in red font purposefully. This is swap. Because of the customer's default, bank had to sell and bank had to purchase. The difference between these two rates is swap gain or loss. The difference between the rate at which bank had to sell and the bank had to purchase because the customer defaulted is swap gain or loss. Okay. And this rate versus this rate is the cancellation rate, and that is cancellation charge, which is our first question. Is it right? This is cancellation. This 2 in red font is swap, and the C versus D will be required for interest calculation. Perfect. If somebody can explain it to you like this, you can always solve. But of course, you will have to also think and spend time on this. Okay. It is not a magic that you will understand in one go. But if you also put efforts, the efforts which we as a teachers put, you will understand. And it takes time to explain, okay. Even though it is a revision batch, but still I want that you must understand. I am expecting this question now in the exam. First question 1 is cancellation rate. Cancellation will happen after 3 days if the customer does not come within 3 days from the due date. Suppose you don't have time in the exam, don't draw the table, summary table. But summary table is everything. Write down. Now write down little fast. Rupees per dollar, market buying rate. Rupees per dollar, market buying rate. Rupees per dollar, market buying rate. The applicable rate is spot rate on 7th April. But because you are using buying rate, you have to deduct margin. Less margin at the rate 0.10%. Less margin at the rate 0.10%. Very good. Come on. 0.0732. You can just round off in 4 digits because the problem says in the last paragraph, rates must be rounded to 4 decimal places. Last line of the question. So therefore the cancellation rate will be 73.0843. Check. But one more instruction in the last paragraph. It should be in multiples of. It should be in multiples of 0.25. So we have to round off in multiples of 0.25. So 0.43 is near to which number? Is it near to 25 or near to 50? Near to 50 because the gap is 7 points only. With 25 the gap is 18 points. So I will round off to 73.0850. Okay. 2 marks or 1 marks or 1.5 marks. So please note down. I have to move fast now. Everything has been explained. You can watch the video again. 73.0850. Step 2, write amount payable on $1 lakh. Amount payable on $1 lakh. Amount payable on $1 lakh. So you have already computed the cancellation rate. So initially the bank had entered into a contract to sell dollar at 73.8775. 73.8775. So the amount comes to 73,87,750. Bank buys at 73.0850. 73,08,500. So the amount payable by the customer is 79250. This is your second answer. 1.5 marks for this much effort. But for that, this rate you must have found out properly. Is it right? When you will appear for some banking company interviews, suppose after you qualify you go to some bank, then you have to prepare this chapter because they can ask you question on this in interview. Now I will go back to the question to answer the third part, swap loss. Swap loss. The bank had to enter into a sale transaction at this rate and bank had to enter into a purchase transaction at this rate on 4th April. The difference between these two rates is the swap gain or loss. In your table, it is point number, I think E and F. Just check E and F. In interbank, A, B, C, D, E, F. In the table, summary of transaction table. Yes or no? D and E. D and E. Okay, sale spot. Yes, sell, yeah, D and E. Sale. Swap loss write down. Bank sales to the market 73.2775. Bank buys from the market at 73.4275. Take the nearest month. Take the nearest month. Be hopeful. Take the nearest month and then write down swap loss per dollar. Swap loss per dollar. Swap loss per dollar. Because of the default of the customer, bank had to buy at a higher rate. Bank had to buy at a higher rate. Bank had to buy at a higher rate. So what is the total swap loss for $1 lakh? Total swap loss for $1 lakh will be 1 lakh into 0.1500, 15,000 rupees. 15,000 rupees. Now I'll go back to the question again. What is your next question? Interest on the outflow of fund. Is it right? So now you see, bank has to enter into two transactions on 4th April, which will result into net inflow or outflow. It is purchasing from interbank at the contracted rate 73.7575, the highlighted figure, and it has to sell in the interbank market today at 73.2775, which is also printed in your book. So that difference will, C and D difference will result into 12% interest on the differential amount. 12% interest on the differential amount. Write down step 4. Interest on the outflow of fund. Interest on the outflow of fund. Right hand side amount. Right hand side amount. Bank buys at what rate? As per the contracted rate. 73.7575. Bank sales at 73.2775. So is the outflow, or is it outflow or inflow? Outflow, because you are buying at a higher rate, so there is more cash outflow. Outflow per dollar. Outflow per dollar. A minus B. Outflow per dollar, come on, 0.4800. Outflow for $1 lakh. Outflow for $1 lakh. You have to multiply now. So you have 48,000. Now this is not to be recovered from the customer. Interest on that will be recovered from the customer at 12% for 3 days. At 12% for 3 days till the cancellation date. Till cancellation date. Because on 7 the contract will be cancelled. Round off the amount. 47. Round off, no problem. Is it 47? Make it 47. So this is how interest is calculated. And come back to your next question. What is the new contract rate? The customer comes on 14th April. The customer comes on 14th April. He wants to take a forward contract for 14th June. Sorry. The bank would sell dollar to the customer. Yes or no? So higher rate. Plus 0.10% margin also, because you are selling to the customer. So you'll have to apply 0.10% margin. So I will take this rate. You can also tick mark in your book. And you have to add 0.10% rounded off to 0.25. Rounded off to 0.0025. So write down new contract rate. The new contract rate, step 5. The new contract will be executed at current rate. So whatever on 14th April the rates are available, those rates will be considered now. It is like a new contract. It is like a fresh contract now. It is like fresh contract. Right hand side amount, rupees per dollar. Write down rupees per dollar market forward rate for June. 73.7050. Whenever a customer wants to buy dollar, banks apply selling rate, higher rate. But because the rates are with interbank, we have to sell to the customer. Bank will add exchange margin, profit margin at 0.10%. 0.0737. .0737. Is it right? So new contract rate will be 73.7787. Rounded off to, now this 0.87 Is it closer to 75 or is it closer to 100? Very close. With 75 the gap is 12, with 100 gap is 13. So maybe you can take it 7775 also. Okay. So rounded up to, you can write 74.7775, because if I am taking 87, 75 is closer. 74.7775. Yes. Last question. Total cost. Total cost will be sum of three figures: cancellation charge, interest and swap loss. Cancellation charge, which is answer in point number 2, swap loss answer in point 3, and interest answer in point 4. Write down. Write down cancellation charges. Cancellation charges 79,250. Swap loss 15,000. Interest step 4 47. The student is asking previous answer should be 73.7800. Just let me check. The student is saying it should be 73.7800. I said 73.7775. So we have to round off to the nearest 25. If I take 75, the gap is 12 points. If I take 800, the gap is 13 points. So the nearest will be 75. We have to take the nearest figure. Okay. So the answer is 73.7775. Okay, come back to this question. Interest is 47. Therefore, total charges 94,297. 94,297. This is very good question for exam purpose. This is called complication. Okay. Previous one was a small kid in front of this. Okay, Preeti, is it right? Now we'll go to one more wonderful question. 5. One more question for today. Are you ready? Say yes. If we solve this question today, then tomorrow we can complete the remaining question. So our revision session will get over by tomorrow, but then I need to complete this question today. Okay. So last question for today, question number 5. It is 8-mark question. July 21 exam. XP Pharma Limited has acquired an export order, underline export order, underline, for rupees 10 million. Amount is 10 million for formulation to a European company. The company has also planned to import, underline import, bulk drugs worth 5 million from a company in UK. The proceeds of the export will be realized in 3 months. So export realization is after 3 months and the payments for imports will be due after 6 months. 3 months export, 6 months import. These are two different questions. The invoicing of these exports and imports can be done in any currency. That is, 3 options are there: dollar, euro, pound, at the company's choice. So what do you do? Please reply. If you are exporter, you will choose the option which gives you rupee inflow maximum. And if you are importer, you will choose that option which will result into rupee outflow minimum. Understood? Say yes. Yes. Advise XP Pharma Limited about invoicing in which currency? Calculation should be up to 3 decimal places. You are given spot rate. In order to calculate the forward rate, they have not given you forward rate, but they have given you annualized premium. Annualized premium percentage per annum is given. For export, you have to take 3 months, 3 by 12 of this. And for import, 6 by 12 of this. You will add in spot rate, you will get forward rate, and then using forward rate compute the rupee outflow or rupee inflow. For exporter, choose the highest of the 3. For the importer, choose the lowest of the 3. This is one of the easiest question for 8 marks, but you have to do it very carefully. Step number 1. Decision relating to currency in which export should be invoiced. In which export should be invoiced. Right hand side 3 columns. Right hand side 3 columns. Dollar, euro and pound. Dollar, euro and pound. Okay. So first you write down export proceed in rupees. What is the rupee value of this export order? Rupee value of the export order is 10 million, which is equal to 1 crore. So write down 1 crore 3 times. 1 crore 3 times. Now the next important thing is which rate you will take for exporter. Spot buying rate or spot selling rate. Exporter will bring foreign currency. Bank will buy foreign currency from the exporter and give Indian rupee. Correct? Which rate will be applying? The lower rate or the higher rate? Customer will sell dollar to the bank. Bank will buy dollar. Which rate? Lower rate. Very good. So lower rate means buying rate. So the buying rate is for dollar 67.10. Buying rate for euro 63.15. And buying rate for pound is 88.65. Next line. So invoice amount at spot rate. So we have to convert the invoice in respective currency. A divided by B. Yes, Preeti is right. You have to take bid rate. Very good, Preeti. Wonderful. And now you tell me what is the invoicing to be done in dollar. 149,031.297. You can take up to 3 digits. They have written in the problem last line. Divide 1 crore by 63.15. How much? Euro 158,353.127. Check. Check the calculation. Tell me the answer for pound. Yes, Preeti. Answer for pound. Pound. What should be the invoice amount in pound? Take on your calculator. Now, why are you confused? 1 crore divided by 88.65. You thought you have to multiply. That day is 1 million year away when you'll have to multiply to get the answer in dollar. Okay, we are still 1 million year away from that date when your dream will be realized, that you will have to multiply. For that time being, we have to divide only. Okay, now the important task is exchange rate after 3 months. Exchange rate after 3 months. You are given spot rate, you are given annualized premium, but I have to add premium only for 3 months. Is it right? So I will take 67.10 into 1 plus 0.07 divided by 4 will give you the factor for 3 months. 67.10 into 1 plus 0.07 by 4, that will give you the premium for 3 months. 68.27 rupees per dollar. Next, euros, do the same thing. 63.15 into bracket 1 plus 0.06 divided by 4. 64.10 rupees per euro. Now who will give me the answer for pound? What is the expected forward rate for pound? Expected forward rate for pound, yes, come on, 88.65 plus into bracket 1 plus 0.05 by 4. Is it 89.76? After 3 months you will receive foreign currency, and these are the rates after 3 months. Now you multiply. Now you fulfill your dream of multiplying. So write down amount received after 3 months in rupees. Amount received after 3 months in rupees. Come on, student. You multiply C into D. Multiply column number C, line number C into line number D. These two you multiply. 101,74367, correct? Now next column, this into this. Give me the answer. Yes, come on. What is the answer? 101,50,435. You can round up. These are big numbers. Points will not make any difference. Anybody last answer? Anybody last answer? 101,25,211. Very good. Which is the highest figure? Dollar is higher. Can you see dollar is higher? Dollar has 74,367 here. So write down advice. Because you are exporter, take higher of the three. Advice, write down, since cash inflow is highest in case of dollar. Since cash inflow is highest in case of dollar, invoice should be in dollar. Invoice should be in dollar. Invoice should be in dollar, correct? Now write down step 2. Step 2. Decision relating to currency. in which imports should be invoiced. Decision relating to currency in which imports should be invoiced. Write down 3 columns again. Dollar, euro, pound. Keep space in the columns. Dollar, euro, pound. Dollar, euro, pound. First write down payment to be made in INR. Payment to be made in INR. Go to your question. Second line 5 million, 50 lakh. 50 lakh, or you can write 5 million. And then you write down spot selling rate. You are an importer. Which rate will be applicable to importer in India? Importer wants to buy. Bank wants to sell. So bank will apply higher rate, ask rate, selling rate. Write down selling rate 67.20, 63.20, 88.75. Is it right now? So point number C, write down invoice amount at spot rate. Will you multiply or divide? To convert rupees into dollar, will you multiply or divide? Divide. Divide is right. Divide is right. Same question. So same answer. So you will get $74.404.762. Okay, now student will try next column. Answer please. Next column 79,113.924. Very good. Next column. Next column, yes, answer please. 56338.028. Then point number D, expected exchange rate after 6 months. Expected exchange rate after 6 months. Your spot rate is 67.20 right here into 1 plus 0.07 divided by 2 this time. Sir, why divided by 2? Because the gap is 6 months. So for 6 months the premium will be half. 7% is for full year. So for half year it will be 3.5%. Calculate 69.55 rupees per dollar. Very good. Okay, student, please try next column yourself. Next yourself. What is the answer? What is the answer? 65.10. Round off. Rate you can round off in 2 digits. No problem. 2, 3 is okay. Tell me the last column. Tell me the last column. 90.97 rupees per dollar. Now next is amount to be paid after 6 months. Very easy question. Amount to be paid after 6 months, multiply column C and column D. The mistake you can make is the rate that you can take may be wrong. The premium you may not consider divide by 2 or divide by 4. And some basic mistake like multiplying and dividing when you are converting rupees into dollar. So my first answer is 51,74,851. Next 51,50,316. Last one 51,250,70. Very good. Which is the lowest one? The last one. Because you are an importer, you would like to minimize outflow. So the answer, write down advice. Advice, write down. Advice, write down. Cash outflow is lowest in case of pound. Cash outflow is lowest in case of pound. Cash outflow is lowest in case of pound. Hence, imports should be invoiced in pound. Hence, imports should be invoiced in pound. Hence, imports should be invoiced in pound. Okay. So this answer is over.
Are you feeling overstressed by your CA syllabus? Get the best CA revision lectures by top CA leaders, specially designed to boost your confidence and knowledge. And the best part of the lecture is that they are available at super affordable prices and available at any time, anywhere. So hurry up and place your order from our website Vinod.in. It is a perfect solution for your last minute review.